Namaste, namaskara, vanakkam. Welcome back to my channel. So guys, finally the law paper is over for you guys. And the next beautiful, amazing paper is taxation. When it comes to taxation, there are actually two parts, income tax and GST. And it is, income tax is so vast and you have GST also. So it becomes really challenging to cover both the topics in just 1.5 days before your tax paper. So here I am with a full-fledged exam-oriented revision of the income tax concept. So guys, you know what? Income tax is very vast and it is challenging for you. In fact, GST, you can somehow cover it in a short period of time, but income tax is so vast, it becomes really difficult. A lot of students are scared of income tax paper, especially the latest question paper you saw. It was so complicated paper and a lot of students are scared how to cover this concepts in just short span of time. So here I am with the revision. So if you watch this revision fully, within less time you can cover the full concepts. Then whatever time you have in your hand, you can utilize for GST, or you can utilize for solving some last day revision or LDR questions before you go for examination day after tomorrow. So that is the whole intention of this CA intermediate income tax Thalaiva exam day revision for May 2026 examination. So guys, be tuned in this video till the end. I am damn sure, pakka I am telling you, from this concepts, out of your 50 marker of income tax paper, at least 40 plus marks would be covered from these concepts which we are going to revise. And if you want the PDF which I'm using in this, you can go to my Telegram channel. The Telegram channel link is there available in this video's description. Now coming to how this, what is the pattern of income tax paper from the past three attempts. If we look at the question number one, every attempt it is asked from the total income computation topic only. So 150 marker question with all 5 heads of income and few deductions and those adjustments they will give you. It is going to be a total income computation question, the first question from your income tax paper. When it comes to second question, 2A and 2B, two parts are there. One is 6 marker question, the other is 4 marker. If you closely look at this, every attempt, part 1 of a second question, 2A is asked from residential status topic only, guys. 6 marks, laddu in your pocket if you know this short topic, very important topic. Then if you come to the next part, 2B, for 4 marks, every attempt TDS concept is touched. And mind you, for this attempt, for your attempt, TDS has lot of amendments, TCS has amendments. So I expect beautiful questions would be asked from this topic, TDS. So it becomes really important to cover this also. And 3A and 3B, they try to generally focus on salary, capital gains and IFRS topic. And 4A, if you look at the part 4A, set off and carry forward of losses, every attempt it comes, guys. And 4B, return of income is asked. So if you very well know that from these topics only the questions will be covered, it becomes really important for you to revise at least these topics for your examination, guys. And that is why I am here with this revision where we'll be covering all these topics in this short revision where I cover all the concepts possible. Now, a lot of students are scared of tax paper, but guys, I say all the time, why fear, guys, when tax Thalaiva is here? So guys, you need not worry about revision of so much big syllabus in less time. It is happening. You just watch this video and you will get full confidence. As I told you already, if you want to download this PDF which I am using, you can go to my Telegram channel, Tax Thalaiva. If you type in the Telegram channel, you will be able to see this last day revision, or I'll keep the name of the PDF as exam day revision PDF. So you just download that. It is going to be cakewalk for you. If you're new to my channel, please do subscribe because I keep coming with amazing tax content, 100% English language for all the viewers, guys. And please do like the button if you genuinely liked the way I teach. If you don't like it, please don't like it. Don't like the video, and please comment in the comment section with a positive attitude because manifestation is true, guys. Manifestation is true 100%. So you put it in the comment section. I am going to clear my examination this attempt only, and you see positivity will definitely come to you. And please share this video with your friends also. Let's jump into the first topic, guys. Residential status. The first topic which I'm going to discuss is for 6 marks, guys, mind you. Now, what is the residential status? Where do you live? So depending on where do you live, the country will decide in which country you have to pay tax. But in order to check what is your residential status, there are a lot of conditions test. Now, in case of individual or HF, guys, there are actually, broadly speaking, there are actually two kinds of residential status. Either you are a resident of a particular country or you are a non-resident, means you are generally not residing in that country. So you are called as a non-resident. So resident or a non-resident. Now, whenever you become resident, you have to go one step further and you have to check one more thing called as resident ordinary or resident not ordinary. Resident ordinary means in this year you are resident, but ordinarily in the past history, if we check, or you have been resident in that country for, they will check past 10 years of history and they will decide upon that. So that is called as resident in this year and ordinarily residing in the past few years also. If you are a resident in this year but not have been residing continuously or consistently in this country for a past 10 years or 7 years, then you will be called as resident in this year but not ordinarily resident. Now, how do we check, sir? See, basically there are two kinds of conditions. One is the basic condition, the other is additional condition. In both the basic and additional conditions, there are two conditions. In basic condition, there are two conditions. Any one you have to satisfy. But when it comes to additional conditions, you have to satisfy both. So basic condition number one says, in the current year for which you are calculating the residence or for which you are computing the residence status, you have to check whether you have stayed minimum 182 days or more in the current previous year or not. And the second basic condition says, stay in the current previous year for 60 days or more, and you have to check the past 4 years, all the 4 years put together, have you stayed for 365 days or more. So first basic condition is 182 days or more in the current previous year. Second basic condition is 60 days in the current previous year and 365 days in the last 4 years. Now, any one basic condition you have to satisfy. First, always check the first basic condition, 182 days minimum, have you stayed or not. If not stayed, then come to the second basic condition and check the 60 plus 365 in the last 4 years. You have to check. Okay, let's say for example, you have satisfied any one of the basic condition, then only you will go to the additional conditions. Mind you, if you don't satisfy any one of the basic conditions, you need not check the additional conditions. We check the additional conditions only when you have satisfied the any one of the basic condition, mind you. So very simple, guys. If you satisfy any one of these basic condition, you will be called as resident. But as I mentioned already, it is not just resident. What kind of resident were you? Were you a resident ordinary resident or were you a resident but not ordinary resident? You have to check. In order to check the ordinary thing, you have to go and check the additional conditions, and I mentioned already both the additional conditions has to be satisfied. Now, the first additional condition says that you have been resident. If you have been resident in at least 2 years out of the past 10 years, you are satisfying the first additional condition. And the second additional condition is, in the past 7 years, if you have stayed in India for 730 days or more in India, in that case, you will be called, in that case, you are satisfying the second additional condition also. And if you are satisfying both the additional conditions, you become resident and ordinary resident as well. So if I have to summarize, guys, very simple. Basic conditions, there are two. Additional conditions, there are two. Basic condition, you have to satisfy any one. If you satisfy any one of the basic condition, you become resident. But the story don't stop there. You have to go further and check the additional conditions also. If additional conditions both you satisfy, then only you will be called as a resident and ordinary resident. But if you, let's say for example, you satisfied any one of the basic condition, you became resident, and when you checked the additional conditions, you only satisfied one in the additional condition. In that case, you are resident, no doubt, but you are not ordinarily resident. So you will be called as ordinarily resident only when you satisfy both the additional conditions. Yes. So guys, method to determine residential status is very simple. Basic condition, any one if you satisfy out of these two, you become resident. Clear? Next, basic condition, not even one satisfied or both unsatisfied. You did not satisfy any of these two basic conditions, you straight away become non-resident. Additional conditions, any one only satisfied, you only satisfied one, you become resident but not ordinary resident. Yeah, additional conditions both satisfied, you become resident and ordinary resident also, guys. Please be mindful with this topic, because they may test you in your examination. Now always remember, whenever you calculate the number of days in examination, keep in mind that the date of departure means the date you leave India and the date of arrival into the India, both will be considered to be in India only whenever you calculate the number of days, mind you guys. Now, whatever we discussed so far is a general case. Generally, how we find out the residential status was that. But there are some special cases in which the conditions which I told you here will alter little bit here and there. So the first special case is special case number one. There are four people in special case number one. Two people are leaving India. Two people are visiting India, guys. I repeat, in special case number one, there are totally four people. Out of four people, two people are leaving India, going out of India, and two people are coming to India. Now, who are these people leaving India or going out of India? Are the Indian citizen being a member of a crew of a ship, or going or leaving India for the purpose of employment. So two people either going as a member of a ship or going for a employment purpose outside India. These are the two people going out of India. Now coming into India, there are two people. Number one, if an Indian citizen generally stays abroad but coming to a visit to India, or a person of Indian origin visiting India, any of these two people are covered. So two people going, two people coming, these four people are covered here. What happens in this four people's case? You need to keep in mind one thing. In these four people's case, the second basic condition which I taught you here will not be applicable. Only first basic condition will be applicable. So if the first basic condition is satisfied, that person is a resident. If the first basic condition is not satisfied, there is no option of second basic condition. Straight away, that person is a non-resident. Once the first basic condition is satisfied, you go and check the additional conditions for them. But one more thing, keep in mind, the two people who are visiting India, Indian citizen generally stays abroad but visiting India, or person of Indian origin visiting India. In this case, in these two people's case, guys, this condition will be applicable only if the Indian taxable income is up to 15 lakh rupees only. So the first basic condition only applies. There is no second basic condition. So straight away delete the second basic condition in this. Additional conditions both will remain same. You have to satisfy both the additional conditions. Yes. Now, if you closely look at this, the special case number one which I taught you, Indian citizen or person of Indian origin, I told you here only if the Indian income is up to 15 lakhs, it is covered here. What if a person of Indian origin or an Indian citizen visiting India has an income, Indian income more than 15 lakhs? What will happen? That will be called as special case number two, where an Indian citizen or a person of Indian origin visiting India having Indian taxable income more than 15 lakhs during the previous year. Now, in this special case, what will happen is first basic condition 182 days or more will remain same. But in the second basic condition, if you remember, general second basic condition says 60 days in the current previous year plus 365 in the last 4 years. But in the place of 60, you have to strike off and take 120 days. This is the only change in this special case number two. Two people are covered, but having Indian income more than 15 lakh rupees are covered. Indian citizen or person of Indian origin visiting India. Basic condition number one remains the same. Basic condition number two, in the place of 60, you have to replace 120 plus 365 days. Now, there is one more important point which you need to keep in mind, and that point is very, very simple. See, guys, if you satisfy first basic condition, you need not check the second basic condition, no, because anyone satisfied good enough, then you go and check the additional conditions, correct? But let's say, for example, you are not satisfying the first basic condition, but you are satisfying the second basic condition, then in that case, you are not required to check the additional conditions. I repeat, generally, if any of the basic condition is satisfied, you go and check the additional conditions, right? But in this case, in this special case number two, what we have to do is, if I satisfy the first basic condition, I will definitely check the additional conditions. But if I don't satisfy the first basic condition, but I satisfy this basic condition, in that case, I need not check additional conditions. If I satisfy this directly, in that case, I will be straight away called as resident, not ordinary resident. That's all. Simple. Yes, important note, if satisfies first basic condition, then only check additional conditions. If does not satisfy first basic condition, then but satisfies the second basic condition, no need to check additional condition. Person is resident, not ordinary resident by default, guys. You need to remember this. Now, scope of total income. Okay, sir, I got to know how to find a person's residential status, but what is the use? The use is depending on your residential status, the income tax department will decide which income will be taxable in your hands. If you're a resident, ordinary resident, global income is taxable. If you're a non-resident, only Indian income is taxable. Like this, depending on your residential status, it will be decided which income is taxable in your hands. Now, always keep in mind, resident, ordinary resident is a pure resident of India, and that is why for him any kind of income is fully taxable, be it Indian income or foreign income, be it Indian income or foreign income, any kind of income is fully taxable. Global income is taxable. When it comes to non-resident, mind you, only Indian income is taxable. You cannot tax foreign income of this person. Non-resident, you cannot tax foreign income, only Indian income you can tax. But when it comes to resident, not ordinary resident, very important. When it comes to resident, not ordinary resident, Indian income is naturally taxable, no doubt, but only one kind of foreign income is taxable, which is a foreign business or a profession income, which is controlled from India or from a profession set up in India. Only that PGBP income of a foreign is taxable in this RNOR case. I repeat, in RNOR case, Indian income is fully taxable. But when it comes to the foreign income, only PGBP foreign income is taxable if that business, that foreign business is controlled from India, or that professional income from foreign is from a profession set up in India, only that income is taxable. So in case of RNOR, any kind of foreign salary income, foreign rental income, foreign interest income, that and all you cannot tax, guys. Keep in mind this point. Now, how do I decide, sir, whether an income is an Indian income or a foreign income? How do I know, sir? Very simple, guys. It will depend on two things. Where from the income is accruing or arising, means where the income got generated, and where did you receive the income, in which bank account, where did you take the cash. So two factors will decide whether an income is a foreign income or an Indian income. Because if you don't know whether an income is an Indian income or a foreign income, how will you tax it? So in order to decide, okay, this income is an Indian income, this is a foreign income, the simple point is you need to keep in mind two things. One, where is the place of accrual, where the income got generated, and number two, where the income you received, which place you received that income. These two factors you need to keep in mind. Number one, keep in mind one thing. I told you place of generation of income, place of receipt of income. Any one of these two things happens in India, that is an Indian income. Or both the things happens out of India, that is foreign income. So, you income accrued or arised also outside India, income received also outside India, both the events happening outside India, that is a foreign income. But any among these two happens, even one in India, that is the Indian income. Mind you, keep in mind like this. Now, total income has two kinds of income: Indian income, foreign income. Now, this table will show you how to decide an Indian income or a foreign income. Very simple. In this column, you will see income accrued where. In this column, you will see income received where. In this column, you will see whether that income is an Indian income or a foreign income. Now, in income accrued or arised in India and received in foreign, I told you any one happening in India, it is a Indian income. Income accrued in foreign country, received in India, anyone again happening in India, it is an Indian income. Income accrued also foreign, received also foreign, both happening outside, so that is a foreign income, mind you. India accrued, received also India, that income is an Indian income. Keep in mind this thing. For examination, it will be helpful. Now coming to a concept called as deemed resident. So the name itself says, I am deeming you that you are a resident. You are not a resident actually in India, but the income tax authorities in India will assume that you are a resident of India. Why it is happening? So let's understand. So let's say, for example, you are an Indian citizen. Keep in mind these points, guys. First condition is you should be Indian citizen. Condition number two, you should be non-resident in India. Condition number two is you should be non-resident in India. Condition number three, you are earning any income outside India, but in the country in which you are earning income, in foreign country, you are not levied tax. Let's say, for example, in Dubai, there is no tax. So, you are an Indian citizen. You are a non-resident of India and you are earning any income from a foreign country, and in that foreign country you are not levied any kind of taxes. And if keep in mind your Indian income other than the foreign income, if you have any kind of Indian income more than 15 lakh rupees, if these four conditions are satisfied, you will be straight away deemed as a resident. And always keep in mind one thing: for a deemed resident, we need not check residential status separately. You are straight away called as resident, not ordinary resident. I hope that is clear, guys. Four conditions you need to keep in mind. One, you are an Indian citizen. Number two, you are a non-resident in India. Number three, you have earned any foreign income outside India, but that foreign income is not taxable in that country. And the number 3 point is your Indian sourced income is more than 15 lakhs in this year. You are a deemed resident, and straight away by default you are resident, not ordinary resident in India. Keep in mind these points. Now when it comes to the next topic, which is income from salaries, almost I would say like alternatively, some see, let's say for example last attempt they asked capital gain, this attempt they asked salary. If this attempt salary, next attempt capital gain, that is how they do the thing, guys. So but we can expect some, some sort of MCQ, or as a part of total income salary may be asked. So guys, whenever we talk about salary generally we think that salary means some monthly amount of fixed amount it will come. It is not like that. Salary has a lot of components. Like in salary you will find basic salary, dearness allowance, commission, bonus, advance salary. Like this, there are plenty of things in the salary definition. So we will be looking at those things now. Apart from the basic salary, what you receive something called as dearness allowance. For the inflation purpose, to compensate the inflation, they give you something called as a dearness allowance. Now guys, there are two kinds of dearness allowance, very very important for your examination, because in lot of retirement benefits like gratuity, leave encashment, or pension, you get to compute the salary. There is a salary definition separately given. So you have to understand there are two kinds of dearness allowance: dearness allowance in terms and dearness allowance not in terms. So what is a dearness allowance in terms is that part of dearness allowance which forms part of your retirement benefits. Means whenever you calculate your retirement benefits, sometimes in the formula or the definition of a salary may have DA in terms. In that case only we consider DA in terms. Otherwise it is DA not in terms, which does not form part of retirement benefits. Now coming to the allowances, guys. See, house rent allowance is favorite of examiner. A lot of times it is been asked in the examination. Very simple. What is a house rent allowance? If an employee is working in an organization, the employer will help the employee on the rental expenditure of the employee. So employee may be living in one rented house. So employer will tell, okay, for as a part of your salary, I'll give you this much of monthly house rent allowance I'll give you, so that you can pay rent. That is called house rent allowance. Now any kind of benefit received by the employee from the employer should be taxable in the hands of employee, technically speaking, under the salary side only. That house rent allowance is definitely taxable in the hands of employee, but the government is also giving you some sort of exemption out of the amount which you received. Let's say for example you received 1 lakh of house rent allowance from your employer. Now the government says, I will give you one format. You apply this format and you arrive at the exempted amount. Out of 1 lakh, this much. Let's say for example, when you calculated the house rent allowance exemption, it is coming to 80,000. So out of 1 lakh of your salary income, 80,000 will be exempted, 20,000 only taxable. So guys, it will depend on in which city you are actually working and in which city you have actually taken the house on rent. If you are living in a metro city, guys, in that case, remember least of the following, these three, whatever list of these three will be there, that will be allowed as exemption. Number one, HRA actually received for relevant period. Now what is the relevant period? Relevant period is the period for which you took house on rent in examination. Be very very careful, guys. Now HRA actually received means what? HRA you got from your employer, then you have to take rent paid, how much you actually rent paid minus 10% of salary. Now you will be thinking, sir, what is the salary definition? Only basic, basic plus DA, that is given here. Basic salary plus the dearness allowance in terms plus commission as a fixed percentage of turnover. Mind you guys, commission if it is given as a amount, don't take that. Commission if it is given as a percentage turnover, that only you need to consider. Be very 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 mindful about this fact, guys. So commission as a fixed percentage of turnover you will consider. And 50% of salary. Again, here also salary means the same definition. These three you will compare, whichever is lower will be exempted from your HRA amount what you say. If you live in other cities other than, what are the Delhi, Kolkata, Mumbai, Chennai, other than these cities, you live in any other city, everything remains same, only that in this case of 50 this will become 40. So you need to compare these three things, and whichever is lower will be exempted in your hands. Now coming to some other allowances, sometimes you may be asked in examination, like children education allowance or hostel expenditure or tribal area allowances up to 100 rupees, 300 rupees or 200 rupees per month will be exempted. Now coming to pension means what? After you retire, your employer will give you, because you served the employer for so many years, the employer will give you for your lifetime something called as pension. Now there are two options left out to the employee. Either he can take the pension in a lump sum, in a bulk amount, or he can take monthly pension. So two options are there. Now always keep in mind one thing: if the employee wants to take the pension on a monthly basis, in that case that will be called as uncommuted pension. But if the employee wants to take the pension lump sum, you give me 5 lakhs at one shot, that is called commuted pension. Always keep in mind one thing: if you take pension monthly, it is in the nature of salary only, so that is why it is fully taxable, guys. But if you take in bulk, if you take, that is called commuted pension. In that case, if you are a government employee, whatever bulk pension you took from the government, that will be fully exempt in your hands. Nothing will be taxable. Full exempted. But if you are other than a government employer, means if you are working with any private organizations and your employer is a private employer, in that case you have to check something. Apart from pension, did you receive gratuity? So if you, let's say for example, you are receiving pension and you are also receiving gratuity, you are getting double benefits or not? So if you get double benefit, and in addition to that, if you are expecting exemption, they'll give you less exemption. But let's say for example, there is an employee who is receiving pension, but he did not receive gratuity. Papa, he did not receive gratuity. Let's giving more exemption of pension. That's how you should think. So if an employee received gratuity also, receiving pension also, then two benefits already given to him, so we will give him less exemption. And that's why you see here, guys, if an employee also received gratuity, his exemption will be only one third. One third is what? 33.33% only. But if an employee is receiving pension but not received any kind of gratuity, for him the exemption is more. 1/2 means 50% exemption he will get from the total pension what you receive. So guys, here pension, you see here the term used here is total pension. Total pension means both commuted and uncommuted pension. Sometimes the employee may say, sir, my pension is 10 lakhs. Out of 10 lakhs, bulky you give me 6 lakhs, one shot you give. Another 4 lakhs, you give me monthly, sir. You split that 4 lakhs into 4 years installments, monthly you give. So here you have both lump sum and the monthly also. That is called uncommuted and commuted pension also. That total you have to take whenever you calculate this exemption. Here keep in mind that point. Now coming to gratuity. See, gratuity generally every employee is eligible if he works for, let's say for example, minimum 5 years you work as an employee, you are eligible for gratuity. After 5th year you are eligible. But it is up to you to take the gratuity during the employment itself, or you can wait till the retirement and take it at that point of time. But you do not have patience only. You want it now only. You are not listening to anyone. You want the pension now. You want the gratuity now only. You cannot wait till the retirement. Then the government says, okay, you cannot wait till the retirement. No, then I will not give you exemption also. So if you wait till the retirement, guys, in that case only you see here exemption you will find it. But if you do not wait till the retirement and you receive the gratuity during the employment itself, even before you are retiring, then the government says, I will fully tax you. So you're waiting till the retirement and then getting the gratuity, then go enjoy the exemption benefit also from the gratuity amount. So very simple, guys. If you received any gratuity during the employment, it is fully taxable. But if you received the gratuity at the time of retirement, and if you're a government employee, full gratuity, whatever you received, fully exempt. Nothing is taxable. But if you are a other than a government employee, means you are a private employee, in that case, you have to check again two things. Are you registered under POGA Act, Payment of Gratuity Act? If you are registered under your POGA Act, then the amount of exemption will be lower of these three things. 15 by 26 into salary per month into number of years of completion of service. Now, mind you, since this is Act, Act means what? Statute. As per the law. As per the law, Sunday is a holiday. Correct? And that is why 15 by 26 it is taken and not by 15 by 30. If it is 15 by 30, it will straight away become 1 by 2. Got it? So, as per the Government Act, POGA Act, Sunday is a holiday. So, 30 became 26. 4 weeks in a month, no? So, 4 days of Sunday you leave, 26 will be remaining. So, 15 by 26 into salary per month. Again, here also, salary has a definition, mind you. Number of years of completion of service means how many years you completed service, that you can round off also. How to do round off, sir? Very simple. If it is 25 years, 6 months, still 25 years only. If you go more than 6 months, that will become 1 year. So let's say, for example, 25 years 7 months will become 26. 25 years 3 months is 25 years only. So more than 6 months will be rounded off to the next year. And you have to take actual gratuity is received and maximum 20 lakhs of salary, whichever is lower will come, that will be given as exemption. So let's say, for example, you're a non-POGA employee, you're not covered by any Payment of Gratuity Act statute, then straight away, guys, you have to compare 1 by 2 into average salary per month. Now, what is average? Average means past 10 months average. The month in which you retired, leave that month. Before that, exactly 10 months salary, whatever is there, divided by 10, that will become average salary per month into number of years of service you have to do. But mind you, here rounding off is not allowed because this is not a statute. No, this is not a statute. Non-POGA employee you are, and everything remains the same. Maximum 20 lakhs actual gratuity received, that will remain same. Now, whenever you take the salary here, the definition are different. Under POGA Act, if you are covered, then salary definition is last drawn, means the latest drawn basic salary plus DA both. DA both means dearness allowance, which is forming part of retirement benefit and which does not form part of retirement benefit, both you will consider. But when it comes to a non-POGA employee, always remember, you will take a basic salary, average last 10 months basic salary and last 10 months dearness allowance in terms and turnover commission. Last 10 months, you add all these three and divide by 10, you will get the average salary per month. Now, coming to leave salary or leave encashment. See, employer is telling you take leave, take leave, take leave. But you want to work. Then what will happen? On a holiday also you worked means you will expect extra salary from your employer. That is called as leave, which you had leave. You encashing means you are converting your leave into cash. That is called leave encashment. So, guys, this is also very simple. If you receive the leave encashment during the employment, you do not have patience to wait till the retirement, then the government says you do not have patience, no, I will tax you up, so fully taxable. But if you waited till retirement and you receive your leave encashment during the retirement, at the time of retirement, government employees so anyway fully exempted. In case of private employees, four things you will compare and lower of that will be exempted. First, you take actual leave salary, whatever received. Then you take 10 months of average salary multiplied with 10 and leave credit, whatever you have, that you have to multiply with average salary per month. Now, always remember one thing. Leave credit will be in number of months and not in number of days. Whatever days you will get, you will divide by 30 and you will convert into months. That leave credit in months you will multiply with average salary per month and maximum 25 lakhs. Whichever is lower will be there, that will be exempt. See here, leave credit means, actually leave credit means what? Very natural. How much leave your employer gave to you, how less reduce, how many leaves you took already. Let's say, for example, your employer gave you 300 days of leave and you took only 60 days of leave in that. You utilized only 60 days. Now, how many leave is left? Leave credit is 240 days already. Now, 240 days are left in your hands. But 240 you cannot multiply here. You cannot take leave credit 240 into average salary per month. That is wrong. 240 you divide with 30. Because 240 days divided by 30 days will become number of months. I think it will be some 8 months that you have to multiply. That's how you get. Now, coming to the salary definition, it is exactly same as this definition of non-POGA employee. where you take the basic salary last 10 months, DNS allowance last 10 months, and turnover based commission of last 10 months average you have to take. Now coming to perquisites. Now what is a perquisite? Lot of times your employer, apart from giving you salary, he will also give you something called as accommodation, something like that. Now in case of a government, if a government gives accommodation to a government employee, we have to calculate the perquisite. No, let's say for example, a employer is giving you house to live in. How do you know how much will be taxable in your hands? So in case of a government employee, license fee is taxable. If anything collected from you, you reduce that. That will be called as the unfurnished accommodation perquisite value. So what if, apart from the accommodation, furniture is also given to me, sir? Then whatever value you got here for the unfurnished accommodation, to that you have to add the furniture value of perquisite. So perquisite value of unfurnished accommodation, to that you will add furniture perquisite value. But in furniture there may be two kinds. If the furniture may be owned by the employer, or the furniture was taken on rent by the employer and then provided to employee. Two possibilities are there. If the furniture is owned by the employer, then take the 10% of the cost, because 10% you are you're using it, so 10% you are depreciating it, like kind of that. If the furniture is hired by the employer and then given to you, then you have to take higher charges paid by the employer. From that, you reduce anything collected from you. That will be called as perquisite value of furnished accommodation. If so, first case what we saw is in case of government employee. What if the employee is a non-government employee? In that case also, in case of unfurnished accommodation, means there is no furniture, only house is given. In that case, if the accommodation is owned by the employer, possibility is there or not? In that case, depending on the population, we have to decide how much perquisite value will be there. If the population is up to 15 lakh rupees, you have to take the perquisite value of 5% of salary minus rent collected from employee. If the population is more than 50 lakhs but up to 40 lakhs, you have to take 7.5% of salary minus rent collected. If the population is more than 40 lakhs in which you got the accommodation, then you have to take 10% of salary less rent collected from employee. Now, if accommodation was not owned by the employer but taken on lease or rent by the owner, in that case, you have to compare these two, and whichever is lower will be that will be treated as perquisite. Actual amount of rent paid by the employer or 10% of salary, whichever is lower, from that you can reduce any rent collected from the employee. This was only for the accommodation provided by the employer, private employer. But what if, apart from the accommodation, furniture is also provided? In that case, first you will take the perquisite of the unfurnished accommodation which we calculated. To that you will add the furniture value of perquisite. Again here said the same two things. Furniture is owned by the employer or furniture is hired by the employer. If it is owned, 10% you take. If it is hired, you have to take the higher charges. Now accommodation, if it is provided in hotel sometimes, then 24% of salary or actual charges paid to the hotel, whichever is lower you will take, and anything collected from employee you will reduce. That will give you the perquisite value of accommodation. Now a lot of times what happens, employer will give you loan to the employee at a concessional rate of interest. So that is also a benefit only. Let's say for example, in a bank, loan is given at 10%. But your employer gave you loan at 6%. Then you are benefited with 4% discounted rate of interest. That 4% is taxable in the hands of employee as a perquisite. Mind you, this calculation we will do only if the loan amount is more than 20,000 rupees. Sir, how would I know what is the benefit which I got from my employer? Very simple. Compare the rate of interest of employer with the State Bank of India's loan rate. That will be called as the perquisite. Interest rate charged by SBI minus rate charged by employer you have to do. Now a lot of times gift may be received by the employee from the employer. Cash gift, it is fully taxable, and in kind if it is more than 5,000 it is fully taxable. Now a lot of times employer will give to the employees some mobile assets for usage. Let's say for example, you join employment, you will get laptop. That is for your usage, but that laptop is not taxed as a perquisite. Apart from laptop, any other asset you receive from your employer will be taxable as perquisite. If you receive any other asset which is owned by the employer, then you have to take 10% of cost as perquisite. From that you will reduce any amount collected from the by the employer from the employee. And if the asset is hired by the employer, means the asset was taken on rent by the employer, then rent paid by the employer is a perquisite in your hands. Now, transfer of mobile assets. It is not just for usage, but the mobile asset itself is transferred to you by the employer. In that case, if computer and electronic items are given, you have to take the depreciated value of the asset as the perquisite in hands of employee. Now, at what rate I'll depreciate, sir? You have to depreciate at the rate of 50% on WDV method for each year of usage. If it is motor car which is given by the employer, transferred by the employer, then depreciate at the rate of 20% on WDV method. And in any other asset case, guys, you have to depreciate at the rate of 10% on SLM method basis. Mind you, here only SLM is there, but in these two cases, it is WDV method. Now, a lot of times, the shares of the employer company are given to the employee at a discounted price. Then there is a benefit. Let's say, for example, the fair market value of the price of the share is 120 rupees, but the employee is given an option to buy this 120 rupees worth of share only for 80 rupees. Then 40 rupees is the benefit flown to the employee from the employer. That is called as employee stock option plan benefit. So what is the taxable amount is fair market value of share 120 minus issue price 80. 40 will be taxable in the hands of employee. Now, coming to medical facilities, lot of time what will happen? Medical facilities means if a employee or his family member are not feeling well, if they want to go for treatment somewhere, employer will sponsor for the treatment sometimes. That is called as medical facilities. Now, there are few medical facilities which are exempt, and apart from this, whatever is there, fully taxable in the hands of employee. Number one, what is exempt? If the hospital in which the employee is taking the treatment, that hospital itself is owned by the employer, his own hospital, employer's own hospital, then it is fully exempt. The treatment of the employee is fully exempt. Or the employer is not owning the hospital, but the employer is reimbursing the amount of expenditure of treatment to the employee. In that case, it will be exempt only if the treatment has taken in government hospital, or it is taken in private hospital, but for prescribed disease only, or for COVID-19 treatment. Only these three things are exempt in the hands of employee. What if a employee takes a treatment in a private hospital, but it is not a prescribed disease? Then whatever employer reimbursed, full amount will be taxable in the hands of employee. Keep in mind this thing. And any premium paid by the employer for health insurance of employee also exempt. Yes. Next, if any treatment is required outside India for the employee or any family member, then always remember travel expenditure will be exempt only if the gross total income of the employee is up to 8 lakh rupees, and the exemption will be till the limit what is approved by the Reserve Bank of India. Guys, keep in mind this point. Now, coming to deductions from the salary. See, if you are paying tax under the optional tax regime, maximum 50,000 of standard deduction is allowed. If you pay tax under the default tax regime, 75,000 of standard deduction is allowed from the total salary, gross salary, whatever you calculate. Now, coming to the entertainment allowance, this is also a deduction given for entertainment allowance for the government employees only. This is applicable. How much exemption deduction you will get is will be lower of these three things: 20% basic salary, 5,000 or actual amount received, whichever is lower you have to take. Now, coming to profession tax, any kind of profession tax paid by the employee will be exempted, will be allowed as a deduction, even if it belongs to earlier year also it will be allowed, guys. So that's it from the salary standpoint. Yes. So the next topic is, guys, income from house property. Income from house property, generally they do not ask a separate question as such. It may come as a part of total income computation question, or they may ask you MCQ from this topic. Now, what is income from house property? Any kind of rental income which you earn from a building or a land apartment, that too will be taxable under this head. But mind you, Rent from a vacant land will not be taxed under income from house property. That will be taxed under income from other sources. Now, how do we compute this? Income from house property is a secondary part, but the first thing is you need to understand there are actually multiple types of house properties. Broadly speaking, there are two parts of house properties. One is called as a let out property, the other is self occupied property. The name itself says self occupied property means property used for own purpose. Let out property means you gave the property on rent to someone. Always remember, let out property, if you let out, you will get rental income. That rental income is always taxable, so it is always taxable. In case of self occupied properties, the government says that if you self occupy the property for your own business purpose, means you are using your own building for your own business purpose, then ignore it, don't worry. But if you self occupy any house property for residential purpose, and if you self occupy more than two house properties, then whatever extra house properties you have beyond two will be deemed as let out property. So self occupied property for residence purpose, if you take up to two self occupied properties, it is exempt, because if it is a self occupied property, you do not have any rental income, so there is no income to tax. So that is why it is exempt. There is no taxation. But more than two self-occupied properties you have to choose any two will be exempt. But remaining beyond two, whatever self-occupied properties are there, that will be treated as deemed let out property. And once it is deemed as a let out property, they will calculate expected rent, and that expected rent will go for taxation as GAV. Of course, in case of deemed let out property, you will not have any kind of actual rent, but expected rent they will be calculating. Now, how they will calculate, sir, expected rent, actual rent, everything. See, what is actual rent? Actual rent means the rent which you actually got from your tenant. But expected rent is the rent which is expected by the government from your property. That is called expected rent. But expected rent, sometimes it may not be directly given to you in examination. You have to find out. In order to find out the expected rent, you need to have three factors. Number one, municipal value. Number two, fair rent. Number three, standard rent. If you compare these three things, you will arrive at the expected rent. That expected rent we will compare with actual rent. First, let's find out what I have to compare with these three factors: municipal value, fair rent, standard rent. If you compare municipal value and fair rent, whichever is higher is there, that value you will take and compare it with the standard rent. Whichever is lower will come among these two. That will be called as expected rent. That expected rent you will compare with actual rent. Whichever is higher will be going for taxation. Now you will get a doubt, sir, why we are taking higher of expected rent and actual rent? Because let's say, for example, government is expected rent is, let's say, for example, 1,20,000, but you are offering the actual rent only 1 lakh. Then the government is losing revenue of taxes or not? Yes or no? So that's why higher is given here, expected rent and actual rent, whichever is higher. That will give you gross annual value. From the gross annual value, see, this is the gross annual value is what? The rent which you are offering for taxes. Now, whichever income you offer for tax, you are eligible for claiming any expenditures also. So that's why government is telling we will allow municipal taxes as expenditure, and then if you reduce that, you will get NAV. From the net annual value, two kind of deductions you are eligible. Number one, standard deduction at the rate of 30%. This always you calculate on the NAV, and you are eligible for interest deduction. And finally, you will arrive at income from house property. From examination standpoint, you have to remember few important things. In examinations, directly they may not give you municipal value this much amount. They may change the language as value determined by municipal authorities. If it is given, it is nothing but your municipal value only. Sometimes what they will give you, municipal tax amount, directly amount they will not give. They will tell that municipal taxes paid equals to 10%, and the municipal taxes is 90,000. In that, you have to find out the municipal value. How will we find out? If the municipal tax is 90,000 and the tax rate is 10%, always we calculate the municipal tax on the municipal value only. So if 10% is 90,000, then what will be the 100% of municipal value? That will be 9 lakh rupees of municipal value. So sometimes directly municipal value they will not give. This kind of line they will give you an examination. You have to be really careful. Now coming to the fair rent. Fair rent means, for fair rent they may give you this kind of line in examination, rent of a similar property in similar locality. It means it is nothing but fair rent. When it comes to standard rent, it means that rent as per Rent Control Act. If it is given, that is a standard rent, keep in mind. Now, guys, I told you already, municipal taxes you can claim deduction, standard deduction you can claim as deduction, and you can claim the interest expenditure as deduction. But there are some special cases in which municipal taxes is not allowed and standard deduction is not allowed and interest is allowed but with certain limits. This happens especially in case of self-occupied properties. Now keep in mind one thing. In case of a self-occupied property, municipal taxes is not allowed. Municipal taxes is allowed only in case of let out property. And municipal taxes is always allowed only if it is actually paid. If it is payable, it is not allowed. If it is actually paid, then only you can claim municipal taxes deduction. But interest deduction is not like that. Interest deduction, even if it is payable, you did not pay it actually, it is outstanding, still you can claim the deduction. But the twist is, in case of optional tax regime, you can claim, or whether it can be optional or default tax regime, I'll tell you. If it is optional tax regime, under self-occupied property, you can claim interest deduction. But it is under, if it is under default tax regime, for self-occupied property, you cannot claim even interest deduction also. And under optional tax regime, how much interest deduction I can claim for self-occupied property? You can maximum claim 2 lakh rupees. But if it is a let out property, you can claim unlimited amount of interest, whether it is paid or not paid. That is what is summarized in this table. Let's have a look at this. So municipal taxes, standard deduction, interest on loan deduction under optional tax regime or default tax regime. Let's have a look at this. Now, if it is a self-occupied property, for both the properties put together, I'm telling you this, municipal taxes not allowed in case of self-occupied properties. But in case of let-out properties, municipal taxes is fully allowed. Standard deduction. In case of self-occupied property, the GAV and NAV itself is nil, so there is no scope for standard deduction. But in case of let-out property, you can claim 30% of standard deduction. When it comes to interest on loan, under optional tax regime, you can maximum claim 2 lakh rupees of interest deduction. But mind you, under default tax regime, you cannot claim any kind of interest for self-occupied property. If it is a let out property, full amount of interest is fully allowed. One point keep in mind here. Here this 2 lakhs limit will become only 30,000 only if the loan was taken after 1/4/1999 for repair or reconstruction purpose, mind you. Yes, now municipal taxes are allowed only if actual payment is done, but interest deduction is allowed even if actual payment is not done. There is a concept called as pre-acquisition or pre-construction period interest. It may be asked in your examination. Be very careful. Now, before completion of your construction or before purchase of your property, you took loan. So your interest will start from the day you took loan till the date you complete your construction. You have to pay interest. Even after construction gets over also, you have to pay interest. I'm not saying that, but generally pre-construction interest, our mind will think what? From the day I took loan till the day I completed my construction or till the date I acquired my property, that is called as pre-construction interest or pre-acquisition interest, is what the general notion is, but that is not correct. Income Tax Act says that the pre-construction interest will start from the day you take loan, but it will end on the 31st March of the immediate previous year in which the construction got completed. Let's say, for example, construction got completed on today. We are in May 2026 now, for example, or we are in September 2026 or Jan 27, whatever you imagine. We are in a previous year 25-26 in this year, or we are in previous year 26-27, for example. We are in previous year 26-27 in this year, in the middle of this year, construction got completed, for example, but the pre-construction period will end on 31st March of the previous year 25-26, which is 31st of March 2026 itself. So if you are in a previous year, your construction got completed in previous year 26-27, but your pre-construction period will end on 31st of March 2026 itself. That is what is given. Starts from the date of loan, ends on the previous year, immediately ending before the date of completion of construction. Now, whatever pre-construction period interest is there, that will be allowed in 5 equal installments right from the year in which the construction got completed. So, for 5 years, you will be claiming two kinds of interest. Number one, the pre-construction period's 1/5 interest installment, and the current period interest also you will calculate. I have put one beautiful question in Super 7 questions in my YouTube channel. I uploaded one video, Super 7 questions like that. In that, I have picked one amazing question regarding this pre-construction period interest. Somewhere I personally feel this concept may come for examination. Please have a look and go for examination. Pre-construction period interest is allowed in 5 equal installments, 1/5 in each year for 5 years, starting from the year in which completion got over. Now, there are some special cases in income from house property. Case number one, concept of vacancy. Now, what is vacancy and what is unoccupancy? I'll tell you. See, vacancy means the owner gave on rent the property to someone and the tenant vacated the property and the owner is looking for some other tenant, but the property is vacant. That is called vacant property. But unoccupied property means the intention of the owner is not to give the property on rent. Neither he is occupying the property. It is just unoccupied. So don't confuse unoccupied with vacancy. Vacancy means owner is expecting one tenant to come and take the property on rent, but he is not finding a tenant. That is called concept of vacancy. Now always remember, in case of concept of vacancy, imagine if my property is let out for 9 months and 3 months it was vacant. Means this was let out period. 9 months there was a tenant, 3 months the property was vacant. Now, if I compare my expected rent with actual rent, my actual rent will be only for 9 months because 3 months there is no rent only. So, whenever I compare expected rent, guys, always expected rent, the standard, the municipal value of fair and standard rent, that will be for 12 months only, no, all the time. If I compare always my 12 months value of expected rent with the actual rent of 9 months, always my expected rent will be more. So, it is injustice for the, for the landlords or the owners of the house property. So, government thought we cannot compare 12-month of expected rent with actual rent of 9 months. That is not a proper comparison. You should compare 12 months with the 12 month. No. So that is why we are adding here 3 months of vacancy rent only for the purpose of comparison. We are adding this VR vacancy rent only for comparison purpose. So if my expected rent is less than or equal to, means this value if it is more than the expected rent, actual rent plus vacancy rent, if it is more than expected rent, I will take my GAV as AR only. I will not add VR for my GAV purpose. I have added vacancy rent only for comparison purpose, mind you. If my expected rent is more than actual rent per vacancy rent, then my GAV will naturally become my expected rent only. Yes. Now, concept of part-year let-out property, part-year self-occupied property. Let's say, for example, a property you gave it on rent for 9 months. 3 months you self-occupied the property. 3 months you self-occupied the property. Just a moment. Just a moment, guys. So, if 9 months you gave the property on rent, and the 3 months you self-occupied the property, still the property will be called as let out property only. And in this case, we will not split the actual rent into 9 months, 3 months, the expected rent into 9 months, 3 months. That splitting and all we will not do. We will compare the total expected rent with whatever actual rent we have. Even if a single day property is let out, it is treated as let out property only. Compare full year expected rent with actual rent of actual let out period only, guys. We will not add, like here we added 3 months for comparison, but here we will not add because here it is self occupied for part of the year, it was not vacant. So no notional rent will be added here. Municipal taxes will be fully allowed because you are treating it as let out property. Municipal taxes allowed, interest also fully allowed, there is no split at all. Yes, next. Partial house property let out and partial self occupied property. Let's say for example, there is a property which has 3 floors. Out of 3 floors, 1 floor is let out, 2 floors are self occupied property. In that case, you need to keep in mind one thing. Whenever you will calculate the expected rent, actual rent, everything you have to split, guys. Everything you will split. Yes, but keep in mind one thing. The let out property portion, actual rent, you don't split it. Rest everything, expected rent you split. Municipal taxes you split. Interest also you split. Yes, so split everything including taxes and interest based on plinth or portion area. As I told you, if one floor of the 3 floors is let out, then 1/3 only let out, 2/3 is self-occupied property. Now there is something called as joint or co-owned property. In case of joint owned property, simple you do in examination. uh, Generally, imagine as if there is no joint ownership or co-ownership. Simply calculate income from house property. At the end, whatever income from house property has come, that you split in the ownership ratio. Let's say for example, 2 owners are there, both are having same ownership 50-50%. Then income from house property, normally you calculate, at the end you split the income from house property in both the owners and 50-50%. Now coming to unrealized rent rule 4. Now from the actual rent, you can reduce something called as unrealized rent, but you can reduce it only if you are satisfying the conditions of rule 4. The tenancy should be bona fide. The tenant should not be occupying any of your other properties. You should have taken legal action for vacating the property, vacating the owner, vacating the tenant from the property. These kind of 4 conditions are there. Only if 4 conditions are met, then only unrealized rent can be reduced from your actual rent, and you need not pay any kind of tax on the unrealized rent. If in future there is a recovery of unrealized rent for which you already claimed as deduction there, then in future whenever you will recover it, it will be taxed and you can claim 30% of standard deduction out of that. So unrealized rent, if you want to not pay tax on in this year in which you did not realize the rent, you have to satisfy rule 4 conditions. And in future, if you realize the unrealized rent earlier, then you have to offer that rent to tax, but you can claim standard deduction at the rate of 30%. That is the end of income from house property. So the next topic is PGBP. Guys, the total income computation question, the very first compulsory question, total income, 15 marks. Most of the adjustments would be covered from this PGBP topic only. So very important chapter to cover. So first thing is, guys, in PGBP what happens? There will be one profit and loss account statement. On the credit side, all incomes will be there, and on the debit side, all expenditures will be there. On the credit side, you can only credit the business income items, and on the debit side, you can only claim the business expenditures. That too, you can claim the expenditure which are allowed as per the Income Tax Act. You cannot claim any expenditure which is not allowed as per the Income Tax Act. Now, when it comes to the credit side, generally section 28 says that any kind of income which you earn through a business or profession will be taxed under the income tax law. Now, when it comes to the expenditures, section 32 says that you can claim depreciation. But mind you, depreciation, what you calculate as per the accountancy, the asset wise depreciation, that you cannot follow here. Here you follow something called as block of asset method of depreciation, where you block the assets depending on the same class and same category of assets in a block, and you calculate the depreciation as per the WDV method of depreciation. Mind you, WDV is mandatory, but there are actually 2 methods of depreciation, SLM and WDV. SLM, straight line method depreciation, is available only for power generating units. For all other business people, only one method, WDV method, is allowed. And as per Income Tax Act, you can claim the depreciation only if the asset is actually put to use. If the asset is not put to use, you cannot claim it. And the assessee must be owner of the asset. And if you have used the asset for less than 180 days in a year, you can claim only half of depreciation. If asset is used more than 180 days in a year, you can claim full rate of depreciation. Now, the half rate of depreciation, this less than 180 days condition, applies only in the year in which the asset is purchased and put to use. Let's say, for example, in this year I purchased an asset, but I did not put to use the asset in this year. Rather, I started using the asset in the next year. In next year, I will not check this 180 days criteria. I will only check this in the year in which the asset has been purchased. So in examination, if you want to remember, if the asset is put to use up to 3rd October, it is straight away full rate of depreciation you can claim. Because 3rd October is the cutoff date for 180 days, you can calculate. In examination, all the time you did not calculate. No, if you know, okay, 3rd October, up to before 3rd October, if it is used, it is full rate, I can claim the depreciation. If the asset is used on or after 4th October, it means it is used for less than 180 days, half rate of depreciation only eligible. Now, how to compute depreciation, sir? See, as I told you already, block of asset or WDV method is calculated. So you need to take first the opening WDV of the block. Then to that you will add the assets which you purchased during the year. From that you will remove whatever assets sold during the year, and on the balance will be called as WDV for the purpose of depreciation. On that you will calculate the depreciation. Got it? Now, whatever we discussed is normal depreciation. There is something called as additional depreciation. Additional depreciation is provided only in special cases where it should be a new plant and machinery. These conditions are very, very important in examination. Very, very important. But keep in mind one thing, this additional depreciation is not eligible under default tax regime. It is only available under the optional tax regime. But there are conditions, means the asset which is eligible for additional depreciation is new plant and machinery. Mind you, this should be new. And the machinery should be used in manufacturing business or power generation business, and the assessee shall pay tax under the optional tax regime. And only if wait a second, only if WDV method is followed, you can claim additional depreciation, and the additional depreciation rate is 20%. If you use the asset for less than 180 days, this year you will claim 10% half, and then you will claim the next half 10% in the next year. That is what is given here. Plant and machinery, if it is used in residence or office purpose, it is not eligible for additional depreciation. You should use the plant and machinery only for manufacturing purpose. Forklift truck used in factory, you can claim it for additional depreciation because that is used in manufacturing process, and in printing business is treated as manufacturing business only, and it is eligible for additional depreciation. Next comes the scientific research. See, for scientific research, there may be two criteria. Either you are doing research by your own, you have your own lab, scientific lab, and you are doing research. Or you are not doing research in your scientific lab, you are donating or contributing some amount to someone who is doing the research. So, if you do your own research, it is called in-house. Inside the house, you are doing in-house research. Or if you are giving any donation to outsiders, these two criteria are covered. If you do in-house research, guys, generally remember, generally all revenue expenditures are allowed, and all capital expenditure are also allowed, but except land, guys, except land. And of course, if on capital expenditure 100% you can claim as deduction here, then you are not eligible for any kind of depreciation. I repeat, if you do in-house research, whatever expenditure you are incurring, revenue or capital expenditure 100, even capital expenditure 100% allowed in the year in which you incur the expenditure. Of course, no depreciation is allowed. But mind you, except land, means land is not eligible for deduction under section 35. But in-house research, you need to keep in mind one point. If you carry on the in-house research before commencement, pre-commencement, if you carry on the research, in that case, only up to 3 years before commencement, you can claim the revenue expenditure being a salary but excluding perquisites, and raw materials you can claim. But up to 3 years before commencement, pre-commencement, capital expenditure you can fully claim except land. But when you donate to outsiders, you have to donate to approved or notified approved institutions only. Whatever amount you contribute or donate to outsiders for scientific research, 100% of it is allowed under section 35. Now, whom to give this contribution, sir? To any scientific research organization, social statistical research organizations, universities, IITs, college, Indian company, any of these organizations, if you give or contribute any amount, it is eligible for 100% of deduction under section 35. Mind you, one very, very important point. In-house research expenditure you can claim under optional tax regime on both under default tax regime also. But when it comes to the contribution or donation to outside organizations, you can claim the deduction only if you are paying tax under the optional tax regime only. Under default tax regime, this is not allowed. Keep in mind this very, very important point. Now comes the section 35 AD. If you remember, there are some list of businesses given like 2-star hotel and above, hospital with 100 beds, honey beekeeping, warehouse facility for sugarcane, wheat, something like that, and all some list of 35 AD businesses given. If the SSC starts any of these businesses and do any kind of capital expenditure for those business purposes, 100% of capital expenditure is allowed as deduction. But three kind of expenditures are not allowed under section 35 AD. Number one, goodwill, financial instruments and land. So if you invest in goodwill or financial instruments or land, then those capital expenditures you cannot claim deduction under section 35 AD. Now, one more point, 35 AD is also one such expenditure which is only available for deduction under the optional tax regime. This is not available under the default tax regime, mind you. Now, there are some conditions which are attached for claiming deduction under section 35 AD. New business setup. It should be a new business setup. Means you should not be a continuance of an old business, it means to say. And plant machinery should not be more than 20% old. Let's say, for example, you have 100 lakhs worth of plant and machinery. In that, at least 80 lakhs worth of plant and machinery should be new, and the rest balance 20 lakhs can be old plant and machinery. Mind you, imported plant and machinery will be treated as new only all the time. No deduction under default taxation. This I just now told you. Of course, if you are claiming 100% of the capital expenditure in your profit and loss account under 35 AD, you are not eligible for depreciation on that. Pre-commencement capital expenditure is also allowed, and there is a lock-in period of this asset. If you claim deduction, 8 years you cannot sell that asset. Now comes the next one, which is section 40A1 and section 40A1A. If you remember, there is a chapter called as a TDS, where if you are making any payment to someone, you are required to deduct the TDS. If you deducted the TDS but not deposited with the government, or you did not deduct the TDS only in these two cases, I repeat, either you deducted but not deposited the TDS with the government, or you did not deduct only the TDS, in these two cases, this section 40A1 and 40A1A will be triggered. Now, 40A1 will be triggered if you are making any payment to non-resident and the TDS is not deducted. In this case, if you make any payment to non-resident without deduction of TDS, 100% of the expenditure will be disallowed. 100%. But if you make any payment to resident without deducting TDS, or TDS is not deposited after deduction, in that case 30% of the expenditure shall be disallowed. Keep in mind, these points are, guys, PGBP, whatever I am discussing, these points are asked as a part of total income computation question. Very, very important. If TDS is deposited in subsequent year, then in the year in which you deposited the TDS, in that case whatever disallowed earlier will be allowed in that year. Now comes the 40B. This time, I think in examination, this may be asked in examination. Some disallowances in hands of partnership firm. Now, in partnership firm, Partner may get remuneration, partner may get profit, partner may get interest on the capital contribution. Always keep in mind one thing. Partner, if he gets any share of profit from the partnership firm, that is totally exempt in the hands of partner, because it is a business profit on which already partnership firm paid taxes. But if a partner receives any remuneration or interest, that is covered under section 40B. Now, what 40B says, any kind of remuneration or interest given to partner will be allowed as a deduction in the hands of partnership firm as an expenditure only if it is authorized by the partnership deed first of all. And the partner to whom the remuneration or interest is paid, that partner should be a working partner. Any kind of payments made to non-working partner is not allowed as deduction in the hands of partnership firm. And if any payment is unauthorized by the partnership deed, that is not allowed. And always keep in mind one thing, partnership deed cannot approve prior period payments. Means, let's say for example, deed was created today. Today when the deed is written and created, you cannot say from past 5 years, whatever partnership firm paid to the partners, that also approved. Cannot. From today, from the day on which you created the deed, from that day, whatever payments are there, approval can be given or authority can be given or authorized by the partnership deed. Any payment to non-working partner is disallowed. Unauthorized payments is disallowed. Any payment before the date of partnership is disallowed. And keep in mind, interest on partner's capital contribution should not exceed 12%. Now, let's say for example, partnership deed authorizes 15% per annum of interest. Still, you cannot say partnership deed is authorizing no 15% I will allow. No, you cannot allow. Maximum 12% as per the income tax law itself. So it does not matter how much your partnership deed is authorizing, but Income Tax Act says maximum 12% of per annum only you can actually claim the deduction. Now coming to the partner's remuneration. This, mind you, in case of working partner only it is allowed. Now, how to calculate what amount of remuneration is allowed in the hands of partnership firm? That will depend on your book profit. Now, what is book profit? Book profit is nothing but that profit after claiming all the deductions except the remuneration for which you are claiming for which you are calculating. Means you can claim all business expenditures as per the income tax law. You can claim the interest deduction also as per income tax law, but except the remuneration, that is called as your book profit. That book profit you will take and you have to calculate the eligible amount of remuneration which you can claim as deduction in the partnership firms. And on the first 6 lakhs of book profit, you can take higher of 3 lakhs or 90% of book profit, whichever is higher. On the balance book profit, you can claim 60% of book profit. Let's take one example. Book profit comes to 10 lakh rupees. Now, in this 10 lakhs, on the first 6 lakh rupees, you have to compare 3 lakhs and 90% of 6 lakhs, which is 5 lakh 40,000 came. So, 5 lakh 40 and 3 lakhs, whichever is higher is what? 5 lakh 40 only. So, we took 5 lakh 40 here. But the total book profit is 10 lakhs. We only calculated for 6 lakhs now. The balance book profit is 4 lakh rupees is there. Now 60% of 4 lakh rupees of book profit will become 2 lakh 40,000 rupees. Now 540 plus 240 will become 7 lakh 80,000 rupees. This is the total amount of eligible deduction of remuneration of the partner. But let's say for example in the P&L of the partnership firm, remuneration actually paid was 8 lakh 50. But can the partnership firm can claim 8 lakh 50? No, the partnership firm can claim only 7 lakh 80. Now how much disallowance will be there? Because already 8 lakh 50 you claimed as expenditure already. You have to disallow the balance of 850 and 780, which is 70,000 rupees will be disallowed in the hands of partnership firm. The next payment is 40A2. Any payment of excess or unreasonable payments made to any partner of the to any relative. See, in order to claim more expenditures, you will claim more expenditure in the profit and loss account and you will show that you have made any payment to relative in excess. that reason unreasonable or excess payment will be to a relative will be totally disallowed. So excess or unreasonable payment made to any relative shall be disallowed, guys. Yes, next. Section 40A3. It says that if any payment or aggregate of payments to a single person in a single day, if it is made other than in the prescribed modes more than 10,000 rupees, that expenditure you cannot claim as expenditure in your profit and loss account for PGBP purpose. Now, what are the prescribed modes? Account pay check, account pay bank draft, and electronic clearing systems. But mind you, in examinations, sometimes they may confuse you. They may give you crossed check or a bearer check. Always keep in mind this thing. Crossed check and bearer check is not allowed. Means these are not prescribed modes of payment. When you look check, you will see, you'll think it is bank transaction. It is not. You cannot claim the expenditure. Next one is 43B. There are certain payments which are allowed only if actual payment is done before the date of filing of return of income. Apart from these expenditures, any kind of expenditure for a business, you can claim on accrual basis of accounting even if the payment is not done yet. So following expenses are allowed only if actual payment is done on or before the date of filing of return of income. First one, taxes, duty, cess or fee, employer contribution to recognized provident funds, statutory or superannuation funds, gratuity, bonus, commission, leave encashment, interest on loan from bank, Indian Railway payments, or any payments to MSMEs. These things are covered. When I say MSME, only MSC, micro and small enterprise is covered. Medium enterprises are not covered. Now, these payments, if you make before filing the date of return of income, it is allowed. Otherwise, it is not allowed. It will be allowed in the year in which you make the payment later on. Now, when it comes to MSC payments, keep in mind one thing. If you purchase any goods or services from a MSC entity, if there is an agreement available, you can make payment maximum within 45 days. If there is no agreement, you should make the payment maximum within 15 days of purchase. Mind you, small and micro enterprises only covered here. Next comes something called as tax audit. Tax audit under section 44AB. Now, who are required to undergo or audit under the Income Tax Act? If you are under a specified profession, if you are carrying on, if your gross receipts are more than 50 lakhs, you are supposed to get your books of accounts audited. But if you are a business person and your turnover is more than 1 crore rupees, generally you are required to get your books of accounts audited. But you need not get your books of accounts audited even up to 10 crores of turnover limit, provided your receipts and payments in your business more than 95% have happened through prescribed mode of transactions. Then the higher threshold limit of 10 crores, up to 10 crores, no need of audit. And in special cases like under 44AD or 44ADA or 44AE, under the presumptive income basis, you are not ready to offer the minimum 8%, 6%, 50%, whatever, then you have to get your books of accounts audited under 44AB. Now, what is this presumptive basis of income? The government is saying if your turnover is up to certain limit, you offer this minimum income as your income. I am happy. You need not maintain your books of accounts. You need not get anything audited. That's all. So if you are a business person and if you want to pay tax under the presumptive basis, you want to offer your PGBP income, that can happen under section 44AD. This is applicable only in case of resident hedge, individual HF or partnership firm. LLPs are not covered here. And you should not be claiming 10AA, 80IA to 80 IRA, RRB. If your turnover is up to 2 crore rupees, you can actually enjoy the benefit of presumptive basis of income. But if you want to enjoy the benefit up to 3 crores of turnover limit, in that case, you have to make sure that at least 95% of your business receipts are in the prescribed modes. Got it? And if you are offering tax under the presumptive basis under 44AD, whatever Turnover receipts you realized through the prescribed mode of transactions like through banks or through electronic clearing systems, 6% of such turnover you have to offer as income. But if you have any other modes, let's say for example, you realized in cash, that cash turnover, you have to offer 8% of that turnover as your PGBP income. Then comes 44 ADA in case of profession, guys. If you are in a notified profession, if you are an individual or a partnership firm, in that case, you can actually offer 50% of your gross receipts as PGBP income if your turnover is up to 50 lakh rupees. But let's say, for example, you want to enjoy a higher threshold limit of gross receipts of 75 lakhs. Up to 75 lakhs, you want to show only 50% of gross receipts. You can show that also, but you have to offer 50% if you want to offer. Minimum 95% should be through the banking channels only, the transactions. In case of goods transport agency or goods carriage business, under section 44 AE, whoever goods carriage business having vehicles only up to 10 vehicles during any time during the year, it should not be owning more than 10 vehicles and is in the business of plying, hiring or leasing of goods carriage. In that case, you can offer income under presumptive basis. If it is a heavy good vehicle, you have to offer 1000 rupees per ton of gross vehicle weight for each month. But for other vehicles, you can offer 7,500 rupees for each month or part of the month wise. Yes. Next. There are certain expenditures which are not allowed under default tax regime. First one, deduction under 10AA we will be discussing shortly in this video. That is not allowed under default tax regime. Additional depreciation is not allowed. Donation means the contribution to scientific research organizations is not allowed, and deduction under 35AD means in PGBP, if you follow default tax regime, these four things benefit you are not eligible for, and that is what ends our discussion on the PGBP topic, guys. The next topic is capital gains. Guys, in capital gains, lot of times a 6-marker question is separately asked as a part of third question. 3A, if you see, past 5 attempts question paper, you pick and check. 3A, it is asked from capital gains only. Now, what is capital gain? Gain on transfer of capital asset. So, whatever profit or gain you earn on the transfer of a capital asset, that profit will be taxed under the capital gains head. See, generally law says that you have to pay tax on the capital gains in the year in which the transfer takes place. But there are some special situations in which capital gain will be taxed in a different year. First one is insurance receipts. If a building is demolished, you are not required to pay capital gain tax in the year of demolition itself. Due to, let's say for example, if fire accident happened, in that year itself, you are not required to pay any kind of tax. You can pay the capital gain tax in the year in which you will receive the compensation from the insurance company. Now, conversion of capital asset into stock in trade. Lot of times, a capital asset may be converted into stock in trade. On the date of conversion, you are not required to pay any kind of capital gain taxes. Because, of course, on the date of conversion, capital asset nature has come to an end, so transfer has taken place. You are required to pay tax, but the government is saying, okay, I'll not ask you to pay tax in the year of conversion. You have to pay tax in the year in which that stock in trade is sold. Okay, so tax in the year of sale of a stock in trade. So in the year of sale of stock in trade, two kinds of income will come. Capital gain also will come and PGBP will also come. Now, whenever you will calculate the capital gain, the full value of consideration you will take the fair market value as on the date of conversion. And for the purpose of cost of acquisition for the PGBP purpose, you will take fair market value as on the date of conversion as the full value as the cost of acquisition for PGBP purpose. In case of compulsory acquisition, Property, if it is compulsorily acquired, it takes some time for you to receive the consideration from the government. And lot of times what happens, government may give you one compensation. You are not happy with that. You may file a case in the court. And then later on, after a few years, you may receive the compensation. So there will be two kinds of compensation: initial compensation, enhanced compensation. Enhanced means what? Extra compensation what you got. Initial compensation, whenever you receive, remember one point: if you received the initial compensation in installments, let's say for example, government told you that they will give you 10 lakhs as initial compensation, but 10 lakhs will be given you in 5 equal installments, 2 lakhs each. Then the law says you will have to pay capital gain tax in the year in which you receive the first installment itself. So in the first year in which you will receive the 2 lakhs of installment, you have to pay the capital gain tax. Let's say for example, you filed a case and you are getting enhanced compensation in future. In that case, enhanced compensation, whenever you will receive, in that year you will pay tax on the enhanced compensation. Now, whenever you will compute the capital gain tax on the initial compensation, you would have already reduced your cost of acquisition for capital gain tax purpose. Then you cannot further again reduce cost of acquisition for enhanced compensation purpose. So enhanced compensation is totally taxable. Got it? Next. Now, capital assets are actually two types: long-term capital asset, short-term capital asset. How will I decide, sir, whether it is a long-term or short-term? That will depend on the period of holding. Now, what is period of holding? Period from the date you acquire the asset until the date you are selling off that asset is called period of holding. The period for which you were holding the asset as a owner of the asset. Now keep in mind one thing: if it is a security listed on a recognized stock exchange, any kind of security, equity shares, preference shares, debentures, all that, but it is a listed on recognized stock exchange, or it is a unit of a unit trust of India, or it is a unit of equity oriented mutual fund, or it is a zero coupon bond, then you have to see that if the asset was held for 12 months or less than 12 months, it will be treated as short-term capital asset. If the asset was held for more than 12 months, it will be long-term capital asset. In all other capital assets case, if the asset is held for up to 24 months, it is short-term. If it is more than 24 months, it is called as long-term capital asset. Now, there is something called as liquidation of a company. Now, what happens in liquidation? In liquidation, the shareholder will receive money from the company because earlier he invested in the company is getting closed. So whatever his investment is there, for that he should get back the money from the company. Now in the time at the time of liquidation, what happens? Company may have something called as accumulated profits. So whatever amount the shareholder will receive in the event of liquidation, up to the extent of accumulated profits, will be treated as deemed dividend in the hands of shareholder. Distribution of accumulated profits of company in the hands of shareholder, in IFRS chapter there is a concept of deemed dividend 222C. So up to that extent of accumulated profits will be treated as deemed dividend in the hands of shareholder. But whatever money he receives more than the accumulated profits will be taxable under the capital gain. Now, why we are calculating capital gain? Because ultimately the share is getting transferred. No, because there is no more company, is no more there, it is getting liquidated. So whatever share you have, that equity share is coming to an end. In that case, how will you calculate capital gain? Very simple. Whatever full value of consideration is what? The amount what you are receiving from the company. It may be in the form of cash, or it may be some fair market value of any assets you are receiving. That you will be adding. From that you remove the deemed dividend which you already offered to tax under IFOS as a deemed dividend to the extent of accumulated profits. That will be called as full value of consideration. From that full value of consideration, you remove the cost of acquisition of shares and you will arrive at the capital gain, which has to be taxed under the liquidation concept in the hands of shareholder. when it comes to the concept of buyback, now what happens in buyback? Company will buy back its own shares from the shareholders. There is an amendment here. Up to 1/10/2024, the company which is buying back the shares from the shareholders used to pay tax. Actually, what happens in buyback? Let's say, for example, 100 rupees share is there. Company is paying 120 to the shareholder. So company is distributing income of 20 rupees extra to the shareholders. Who should pay tax technically? The shareholder should pay tax on the 20 rupees. But earlier, before 1/10/2024, company only used to pay tax on the 20, which is called as distributed income. On the distributed income, 20 rupees distributed to the shareholder. That distributed income at the rate of 20%, the company used to pay tax, and the 20 rupees income was actually exempt in the hands of shareholder. Then later on, in 1/10/2024, there was an amendment in the income tax law. And the income tax law got an amendment that this is totally injustice to the shareholder, to the company. Why the company is paying tax on that? Then they changed the law and told that after 1/10/2024, in case of buyback transactions, company will not be paying any kind of taxes. But the shareholder has to pay tax because it is ultimately the shareholder who is receiving the income. No, but there is a twist here. Income tax law told that whatever amount distributed, now how much is the amount paid for the buyback by the company? 120, no? Now the law says 120 will be treated as deemed dividend in the hands of shareholder under section 222F. 120 will be the full buyback amount is deemed as dividend in the hands of shareholder. So 222F is a IFOS section. So that 120 rupees will be taxed under IFOS. Now you will get one doubt. Sir, income is 20, no? Why are we taxing under IFOS 120? That is wrong. Correct, that is wrong. But the law is like that. 120 is taxed as deemed dividend under 120 under IFOS. But the twist is what you know. Now, in buyback, capital gain also you need to calculate, because ultimately what is buying back? Shares are being bought back. Means you're losing share. Losing share means transfer of equity share is happening. Transfer of capital asset is happening. Capital gain should come. For capital gain purpose, full value of consideration should be there. The full value of consideration will be taken as nil always in case of capital gain. And you will reduce the actual cost of acquisition. You will end up with a loss. Means here that 100, if you reduce from 0, you will get negative 100. And in IFOS, you are offering 120 rupees. In capital gain, you are ending up with a loss of 100 rupees. Net will be what, 20 rupees income only you are paying actually tax on. So capital loss will be 100. IFOS income will be 120 as a deemed dividend. That is how 20 rupees will be taxed in the hands of shareholder on or after 1/10/2024. Please have a look at the buyback taxation and go for examination. This may be pakka asked in examination this attempt. Now, how to compute capital gains? Very simple. Take the full value of consideration, which is sale value. From that, you reduce your transfer expenses, anything is there. That will give you net consideration. From that, you remove cost of acquisition, cost of improvement, you will get the capital gain. You know what? I have not taken intentionally here indexed cost of acquisition and indexed cost of improvement, because after 23rd July 2024, there is no concept of indexation, mind you. Yes. So that is why I have not taken indexation here. Securities transaction tax are not allowed as here. Transfer expenses are not allowed. Yes, as securities transaction tax. So this is what I was telling, indexation benefit. If the transfer happened before 23rd July, it was available, but transfer on or after 23rd July 2024, indexation benefit is not available, mind you guys. Now, see, as on 31st of Jan 2018 or before that, if you were holding any of these three assets, business trust unit, equity shares, or equity oriented units, if you are owning any of these assets on or before 31st of Jan 2018, means you purchased any of these three things before 31st of Jan 2018, but you sold them after 31st of Jan 2018, then you cannot consider actual cost of acquisition for your capital gain calculation purpose. So in capital gain, what do we do? Full value of consideration minus cost of acquisition. That cost of acquisition, you cannot take the actual one. You have to grandfather your cost of acquisition as per section 55 in case of only these three assets. Now, how to grandfather, sir? Very simple. You will first take the actual cost of acquisition. Then you will take two things: fair market value as on 31st of Jan 2018 and sale value, means the full value of consideration. You will take lower of these two and higher of all these you have to take. That will be treated as the cost of acquisition. Mind you, indexation benefit is not available for this section, and you will take that cost of acquisition for capital gain calculation purpose. Conditions are very simple. Purchase, acquired any of these three assets on or before 31st of Jan 18, but transferred after 31st of Jan 2018. In that case, you will not take the actual cost of acquisition. You have to compare like this, and then only you take the cost of acquisition. Mind you, indexation is not available. Now, sometimes it is seen that in capital gains topic, if they want to ask a separate question, they may ask one slump sale kind of a question. Now, what is slump sale? One unit is sold as it is to someone. Now, what you are selling is not an asset. You are selling one business unit. So, every time keep in mind one thing. Business will have something called as net worth. Net worth means what? Assets minus liabilities. Now, whenever you calculate the net worth for the slump sale purpose, whenever you calculate capital gain, first you will take full value of consideration less net worth. Now, for full value of consideration, you have to compare two fair market values: fair market value of capital assets as on the date of slump sale, or fair market value of consideration, both monetary and non-monetary, whichever is higher you have to take. Now, whenever you will reduce from whatever this you will get higher, you will take it as full value of consideration. From the full value of consideration, you have to reduce something called as cost of acquisition. Now, what will be cost of acquisition? Net worth, I told you. Because net worth is the ultimate thing which you are transferring to someone. Means today's my business net worth is this much, and I am selling my business for this much amount. That difference will be called as capital gain. Very simple. Now, how to calculate net worth? Assets minus liabilities. Whenever you take assets, keep in mind these points. If it is a depreciable asset, you have to take the WDV value. If it is a self-generated goodwill, always take nil. If the asset is there on which you claimed already 35 AD, take the value as nil. And any other liabilities or assets are there, you take the book value. Mind you, ignore the revaluation of assets. Got it? Yes. And one more thing. How to decide, sir, in case of slump sale, whether the capital gain is a short term or long term? That will depend on when did you start your unit, business unit which you are transferring, and when did you transfer it. That duration you will check. And mind you, for slump sale alone, you will not check 12 months or 24 months for long term, short term. You will check 36 months of time, guys. Keep in mind this thing. Indexation benefit is not available here. Now, sometimes what may happen that the stamp duty value of your property may be exceeding the full value of consideration of your property. Means your sale value of the property which you want to claim is actually less than the stamp duty value. In that case, what will happen is you have to take 110% of your full value of consideration and then compare with the stamp duty value. If the stamp duty value is more than 110% of full value of consideration, take the stamp duty value as full value of consideration. If the stamp duty value is less than 110% of the full value of consideration, then take the actual full value of consideration for your capital gain purpose. This applies only in case of land or building or both. Got it? So, if a stamp duty value more than 110% of actual sale consideration, then sale value to be considered is stamp duty value only. If the stamp duty value is less than or equal to 110% of actual sale consideration, then sale value to be considered should be actual sale consideration only you should consider. Now, a lot of times what happens, the date of registration and the date of agreement of the property is different in lot of cases. In that case, which dates SDV we should be taking? See, if as on the date of agreement, you have already taken any part of the full value of consideration as advance in the prescribed mode of transaction, in that case, you can take the SDV as on the date of agreement. But let's say, for example, on the date of agreement, you did not take any advance, or you took advance, but other than in prescribed modes, then you have to compare the date of registration's stamp duty value with your actual consideration. So, I have given one summary here. Is date of agreement and date of registration same? It says no. Means they are not same, they are different. In that case, I am asking again, payment done in prescribed mode or not? It says yes. Prescribed mode of payment you took as on the date of agreement already, then you will take the SDV as on which date to be considered? As on the date of agreement itself. But if the date of agreement and date of registration is not same, and you did not take the advance as on the date of agreement in the prescribed mode, then the date of registrations SDV you will be taking. If the date of registration and date of agreement are same, it does not matter. You take the date on that date's stamp duty value only. Now, a lot of times in examination, they'll ask you that advance money has been forfeited by the owner. See, if the forfeiture of advance happens before 1/4/2014, then whatever amount forfeited by the owner should be reduced from the cost of acquisition. When in future the property will be sold, capital gain will be calculated. In that capital gain calculation, whenever you will take the cost of acquisition, from that cost of acquisition, you will remove the forfeited amount of advance. But if the forfeiture of advance happened on or after 1/4/2014, mind you, directly the forfeiture amount will be taxed under IFOS income as IFOS income. Now, tax on listed business trust unit or equity shares or equity oriented units of a fund. Mind you, whenever there is a transfer of these three things, I shortly call it as honeybee. You remember the honeybee spelling is BEE. Like that you can remember business trust unit, equity share, equity oriented unit. Simple. If any of these three assets are being sold before 23rd July 2024, and if it is a short-term capital gain under 111A, it is taxed at the rate of 15%. But if transferred on or after 23 July 2024, if it is a short term, same 111A is taxed under 20%. Means the tax rates have been increased from 15% to 20% now. If any of these assets is transferred before as a long term capital asset under 112A, then the long term capital gain above 1,25,000 taxable at the rate of 10%. But now the law is on or after 23rd July 2024, if you transfer any of these three assets, and if it is a long term capital gain under 112A, it will be taxed at the rate of 12.5% beyond 1,25,000 rupees. Got it, guys? Yes. Mind you, there is no indexation benefit in this case scenario also. Now, taxation of capital gains. In case of capital gains, what should be the tax rates? Short-term capital gain on the honeybee items, I told you already will be taxed under 111A, that special rate 15% or 20%. And if it is a long-term capital gain on the honeybee items, it will be again 112A beyond 1,25,000, 12.5% or 10%. Any other long-term capital asset will be taxed at special rates under 112, and the rate now is 12.5%. Short-term capital gain on any asset other than honeybee will be taxable at the rate of slab rates only. Got it? Most important point in case of capital gain. Let's say, for example, there is an individual or HUF who purchased land or building or both before 23rd July 2024, but he is transferring that asset after 23rd July 2024. In that case, only in this case it is applicable. There will be no indexation benefit on long-term capital gain computation. Means when you calculate the capital gain, you will not do indexation of the cost of acquisition. But, 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 whenever you will calculate the tax liability on the long-term capital gain, you have two options. Number one, either pay tax at 12.5% without any index benefit, or pay tax at the rate of 20% with index benefit. These two you will calculate. Means only for this purpose, this point purpose, you will do index. But mind you, for capital gain purpose calculation, you will not do any kind of indexation. And when you calculate these two and compare, whichever is low tax liability is coming, that will be taxable. Means they are giving you option, calculate these two, whichever is lower, you pay tax. Got it, guys? Now, exemption under section 54. 54 is very simple. If you have any residential house property, long-term asset, if you are selling and you are getting any long-term capital gain, and if you are an individual or HUF, in that case, if you are selling the residential house property as a long-term capital asset and you have any kind of long-term capital gain, that long-term capital gain will be exempted to the extent to which you are reinvesting the long-term capital gain in another residential house property. It may be purchase or construction. If you are purchasing, within 2 years you should purchase. If you are constructing, within 3 years you should construct. Or recently, just 1 year before, you purchased or constructed any property, against that also you can claim this capital gain exemption. Mind you, what you are reinvesting is not the sale value. You have to only reinvest the capital gain amount only, guys. Keep in mind this point, guys. Yes. Next, the lock-in period is 3 years here, and if you reinvest 100% of the capital gain, 100% will be allowed. Now, mind you, if the long-term capital gain is up to 2 crore rupees, then you have the option to buy or construct two house properties. But always keep in mind one thing, if the long-term capital gain is more than 2 crore rupees, you can only purchase or construct one property. And you know what? This two house properties option is only once in a lifetime opportunity, not every time. And the maximum exemption you can claim under section 54 is 10 crore rupees only. Now comes the 54 EC. Very, very easy. If you are selling any kind of long-term capital asset, if you are selling any kind of long-term capital asset being land or building or both, then whatever capital gain you are earning, you have to reinvest in the notified bonds like NHAI, RECL, PF, PFC, IRFC, HUDCO bonds, which are redeemable after 5 years. Within 6 months from the date of transfer, you have to reinvest. Maximum 50 lakhs you can claim the exemption. Maximum 50 lakhs you can claim the exemption. Got it? Next, 54F. You can sell any asset, but you have to purchase or construct residential house property. That's what this section 54SF says. Any long-term capital asset, if you are selling other than a residential house property, but you are reinvesting in residential house property, in that case, you have to reinvest the net sale consideration and not the capital gain. And the capital gain exemption will be calculated on a proportionate basis. Let's take one small example. Let's say, for example, the sale value of the old property is 100 lakh rupees. Capital gain you got 20 lakh rupees. Now, what you have to reinvest is not just 20 lakhs. You have to reinvest this 100 lakhs in the new property. Let's say, for example, you reinvested only 60 lakhs in a new property. In that case, the total 20 lakhs will not be exempted here. 20 lakhs proportion of 60 lakhs divided by 100 lakhs, only this amount will be exempted in case of section 54F, guys. Just remember this may be asked in examination. And if you want to claim 54F exemption, there is one condition. You should not be owning any other house property when you are claiming this 54 exemption. And there are two other points. You should not buy or construct any other house property within 2 years or 3 years from the date of transfer, guys. So that ends our discussion on the capital gains topic, guys. So guys, the next topic is income from other sources. So whatever income is not taxable under salary, PGBP, capital gains, income from house property will be taxed basically under the income from other sources. In income from other sources, generally dividend is taxable. Now in dividend, there are two kinds of dividend, normal dividend and deemed dividend. Normal dividend, though we know that if a company declares dividend, that is taxable in the hands of shareholder. But lot of times, deemed dividend concept is asked in examination. Now what is deemed dividend? Let's say, for example, there is one shareholder who is having more than 10% of shareholding and voting power in a company, private limited company. Mind you, here private limited company is only covered. And if this private limited company is giving any loan or advance to the shareholder, that loan or advance will be deemed as dividend in the hands of this shareholder. This is a classic case of deemed dividend under section 222E. Now, in first case, the loan is given to directly the shareholder. But if the loan is not given to the shareholder directly, but rather it is given to a concern, means an entity in which the shareholder has substantial interest. In that case, that loan or advance given by the private limited company to any concern will be deemed as dividend in the hands of that concern who receives this loan or advance. So very simple, Mr. X is a shareholder. There is a private limited company. Mr. X is having a substantial interest in any partnership firm or AOP or BOI. In that case, if this shareholder is holding more than 10% of voting power, and if that private limited company is giving any loan to the concern, that loan or advance will be treated as deemed dividend in the hands of that concern, guys. Now, apart from the dividend income, what are the other incomes which are taxable under income from other sources? First one is casual incomes, like winnings. Winnings are straight away taxed at 30%. No expenses allowed, no chapter 6 reductions, no adjustment of basic exemption limit, nothing will be allowed. Straight away it is taxed at 30%, guys. Then interest on enhanced compensation or compensation for compulsory acquisition, if it is received, it is fully taxable and 50% of exemption is given. From the interest on compensation for compulsory acquisition, 50% of flat exemption is given. If any advance money forfeited, we just now discussed in capital gain chapter, it is taxable if the advance money was forfeited on or after 1/4/2014. Rental income of machinery or furniture is taxable. Interest on securities is taxable. Amount received on key man insurance policy. These are the items which are taxable under income from other sources. Next, gift taxations. Lot of times it is asked in examination. Now see, gift may be three things. Either it may be money or cash, or gift of a movable asset, or gift of a immobile property. Any of these three things can be there. You need to keep in mind one thing. In cash, you have to see that cash received from different persons all put together in aggregate. If you have received more than 50,000 rupees in a year, then the full amount of cash gift or money gift will be fully taxable in the hands of the taxpayer. In case of immovable property, if the stamp duty value of the property is more than 50,000 rupees, it is fully taxed if the property is received without consideration. But if the property is received for inadequate consideration, two conditions has to be satisfied. Condition number one, the benefit should be more than 50,000 rupees, and the difference between the stamp duty value and the full value of consideration should be more than 10% of the consideration. In that case, the total difference amount will be taxable as the income from other sources under the gift taxation of 56 to 10. Whenever a movable property is received, you have to understand that the aggregate fair market value of the movable property, if it is more than 50,000 rupees, that full amount will be taxable in the hands of the receiver. Now, gift taxation does not apply in few cases. If the gift is received from relative, or it is received in the event of marriage or inheritance or will, death from a local authority or from a fund or university or hospital, medical institution, from these cases, the gift is not taxed. And if there is gift transfer, even that those kind of transfers which are not regarded as transfer under the capital gain chapter under section 47, that is also not taxable. Private trust, if you receive anything from the private trust, or if you received anything in the COVID-19 treatment or for compensation for death purpose, even that is not taxed under 56 to 10, guys. Next, whatever we discussed is from the standpoint of income. Now, against those incomes, under income from other sources, what kind of expenses can we claim or not? So, allowability of expenses against the IFOS income. Any kind of IFOS taxable income, you can claim expenses, guys. But exempt incomes, you cannot claim expenditure because the income itself is exempt. Why you will claim expenditure against that? Any kind of winning incomes, I already told you, you cannot claim any kind of expenditure. Interest on late compensation for compulsory acquisition, I already told you 50% standard deduction is allowed. And in case of any income from dividend or income from UTI or shares or mutual fund units, you can claim only to the extent of maximum of 20% of such income of interest expenditure you can claim against this income size. This is from the standpoint of income from other sources, very small but very, very important, keep in mind. The next topic which we are going to discuss is TDS. Guys, in TDS there are multiple sections, correct? But there are few sections which are called as hijacker sections, guys, which are called as hijacker sections. Now what happens in TDS? Payer has to deduct the TDS whenever the payment is made. Now, there are some hijacker sections. When I say hijacker, 194H, 194I, J, A, C, R. In these sections, there are some person who are not required to deduct TDS. Who are this person? If you are an individual or HF having no PGBP income, you are not required to deduct TDS. Or if you are an individual or HF having a PGBP income, but your turnover is up to 1 crore or your gross receipts up to 50 lakh rupees, in that case, you are not required to deduct TDS under 194H, I, J, A, C, R. In all other sections, every person is required to deduct TDS if you fall under this limits which are prescribed in this summary chart. So I have summarized all the TDS sections in this beautiful summary chart. First section is 192. 192 says that if any employer is making salary payment to employee, in that case, if the salary exceeds basic exemption limit, then the TDS will be deducted based on the average slab rate based on what kind of tax regime the employee has selected. Under 192A, premature withdrawal of employees provident fund. In that case, if the amount withdrawn is more than 50,000 rupees, in that case, the tax shall be deducted at the rate of 10% by the fund. In case of 193, interest on securities, if let's say for example debenture will pay interest at the time of company, at the time of making interest payments on the debenture, if the interest is more than 10,000 rupees, in that case 10% of TDS will be deducted. In case of 194A, mind you, wherever you see this yellow highlights, these are the hijacker sections in which you are not required to deduct TDS if you are payer of this category. Apart from this category, whoever persons are there, they are only required to deduct TDS under these hijacker sections. Now, apart from these two, who will be there? The persons who is having PGBP income and having turnover more than 1 crore or gross assets more than 50 lakhs, only these people are required to deduct TDS under hijacker. In all other sections, everyone are required to deduct TDS. Now, 194A, interest other than securities, means, let's say for example, loan is given. On that interest, when I am making payment, I have to deduct TDS. Now, normally the limit is 10,000 rupees. But if a bank is paying interest to you, let's say for example, you have a fixed deposit with a bank. Whenever a bank will pay you the interest, in that case, bank will deduct TDS if the amount of interest is more than 50,000 per year. But if the bank pays interest to any senior citizen, the limit is 1 lakh rupees. So if you pay interest to anyone, the limit is 10,000 rupees only. But mind you, whenever you make any interest payment to bank, you are not required to deduct any kind of TDS. What is the rate, sir? Here, the rate is 10% in case of 194A. Then comes 194. Dividend. Whenever a company declares dividend and pays the dividend, if the dividend is more than 10,000 rupees, the TDS shall be deducted at the rate of 10% by the paying company. 194B, BA, BB. These three sections talks about the winnings. Mind you, if the each winning is more than 10,000 rupees, in that case, 30% of TDS will be deducted by the company who is giving you payment of winnings. 194C, hijacker section again, contract payments. If it is a single contract, 30,000 is the limit. If more than one contract is given to a single person, then more than 1 lakh if the contract payments are there, then the TDS shall be deducted under 194C. If the contractor is individual or HUF, TDS will be 1%, and any other contractor, the TDS will be 2%. 194D, insurance commission. If the commission is more than 20,000, the TDS rate shall be, if the company is the payee, then the TDS rate is 10%. In other pays, the TDS rate is 2%, guys. 194G, again commission. Guys, commission, keep in mind one thing, all kind of commission or brokerage have the same limit of 20,000 rupees only, and you see almost the rate of TDS is also same, which is 2%. Next, 194DA, maturity of insurance policy. Whenever a maturity of an insurance policy happens, then whatever income you receive, what is the income? Income means maturity amount minus premium paid. Let's say for example, maturity amount you are receiving 10 lakh rupees, you paid a premium total, all the years put together 8 lakhs you paid, the difference income is 2 lakh rupees. On that 2 lakh rupees, the TDS will be deducted at the rate of 2%. But mind you, if the maturity proceeds are more than 1 lakh, only then the TDS will be deducted by the insurance company. Next comes 194I, rent of plant and machinery or rent of land or building or furniture. Guys, whenever you take any kind of rent, when any kind of asset on rent, in that case under 194I, the TDS will be deducted. If you pay any rent to a single person in a single month more than 50,000 rupees, then you are required to deduct TDS under section 194I at the rate of 2% if the rent is for plant and machinery, and the other assets it is 10%, the TDS shall be deducted. 194IA, transfer of immovable property. If you transfer any immovable property where the consideration is more than 50 lakh rupees, then TDS shall be deducted at the rate of 1% on the consideration amount. Guys, a lot of times SDV will be more than the actual sale consideration. In that case, the TDS shall be deducted on the SDV amount only. Next, 194IB, rent if it is paid by individual or HUF. Other than this 194I section, whoever are covered, apart from that, whoever are covered under 194IB, if the rent is more than 50,000 rupees per month, then the TDS at the rate of 2% has to be considered. Guys, wherever you see green color items, all these are amendments, guys, so you need to be very focused. Next, 194J, professional payments. If you pay any professional fees or technical fees, if for each service if you are paying more than 50,000 rupees, then the TDS shall be deducted. If it is professional fee, you will deduct at the rate of 10%. If it is technical fee, you will deduct at the rate of 2%, guys. 194K income from units. In case of income from any mutual fund units also, if the amount of income you are receiving is more than 10,000, the TDS will be deducted at the rate of 10%. 194 LA. If any compulsory acquisition of any property has happened and you receive any compensation more than 5 lakh rupees, in that case, 10% TDS will be deducted. 194M. If you are not covered under 194C, 194H, and 194J, in that case, if you have made any payment more than 50 lakhs for commission, contract, or professional payments, you being an individual or HF, in that case, you are required to deduct TDS at the rate of 2% under section 194M. M for mix of these three sections. Then comes 194N on cash withdrawal. If you withdraw any cash from the bank will deduct TDS depending on whether you have filed the return of incomes or not. If you filed return of income of all 3 previous years, in that case, the threshold limit is 1 crore. Up to 1 crore, they will not deduct any kind of TDS. But if you withdraw more than 1 crore rupees, they will deduct TDS at the rate of 2%, guys. But if you have not filed return of income of the all 3 previous years in the past, in that case, the starting threshold limit for TDS will be 20 lakh rupees. So if you withdraw more than 20 lakh rupees, the TDS will be deducted. But mind you, from 20 lakh rupees up to 1 crore rupees, the TDS rate is 2%. But if you withdraw more than 1 crore rupees, the TDS rate is 5%. But in case of cooperative societies, the threshold limit is 3 crores. Above 3 crores, if they withdraw cash, they are required to deduct, the bank will deduct TDS at the rate of 2%. 194P, if a senior citizen who is retired, who do not have any other business income or something, have only pension income and have any interest income from the bank, in that case, the bank will deduct a TDS on the total income of a senior citizen on the slab rate basis, guys. Yes, 194Q. If any buyer whose turnover in the last year was more than 10 crores purchases any goods from a single seller for more than 50 lakh rupees, in that case, TDS will be deducted at section 194Q at the rate of 0.1%. If there is no PAN provided by the seller, in that case, the TDS will be deducted at the rate of 5%, mind you. 194R. If any kind of person is paying any business perquisites to anyone, in that case, if the perquisite is more than 20,000 rupees, the TDS will be deducted at the rate of 10%. 194T, payment to partner. In case of partnership firm, if any partnership firm is making payment to a partner more than 20,000 rupees, the TDS will be deducted at the rate of 10%. Just go through this chart before going for examination. Very, very helpful this is. Now coming to TCS. In TCS also there are some amendments. 206C1 says that for alcohol, liquor, tendu leaves, timber, forest produce, scrap, there is no threshold limit, but the TCS rate collected shall be scrap 1%, liquor 1%, tendu leaves 5%, and timber 2%, guys. Wherever you see green, that is all amendment. Now coming to 206C1C. If for lease or license of parking lot, toll plaza, or mine or quarry, for these any payments are done, in that case, TCS will be collected at the rate of 2%. For sale of motor vehicle under 206C1F, for each vehicle, if the amount is more than 10 lakh rupees, in that case, TCS will be collected at the rate of 1%. Guys, mind you here, this is only retail level sale. If B2B sale is happening, if a manufacturer sells a motor vehicle to the dealer, that in that case TCS will not be collected. But ultimately, when the motor vehicle is sold in the outside market, in the retail market, then only from the customers the TCS will be collected. 206C1G, foreign remittance under liberalized remittance scheme, other than, guys, very, very important, this is other than education or medical purpose. In that case, if you're remitting more than 10 lakh rupees, 20% TCS will be collected. But if you're remitting for education purpose, loan funded means what? You have taken from bank loan, education loan, that amount you want to send abroad. And if it is more than 10 lakh rupees, in that case, TCS will not be collected. But if you are sending abroad amount for education only, but your own funds, you have not taken any loan from any bank, and if you are sending more than 10 lakh rupees, TCS will be collected at the rate of 5%. In case of overseas tour program package, the tour operator will collect TCS at the rate of 5% if you are paying up to 10 lakhs, and if you are paying above 10 lakh rupees, TCS will be collected at the rate of 20%, mind you guys. So please have a look at this TDS TCS summary chart. Quickly you will be able to revise and go for examination. Yes, next. Next comes the clubbing of income. Guys, clubbing means what? Someone else's income is getting clubbed in someone else's hands and taxed. So in clubbing, what happens? Let's say, for example, I am the transferor of any money or asset to any other person. That person, if he earns any income out of that money or asset, that income will be clubbed in the transferor's hand. Or in case of minor children, any kind of income they are earning, that income will be clubbed in the hands of parents. First case we are going to take transfer of asset to spouse. So if a husband transfers to wife or a wife transfers to husband any asset without any consideration or for inadequate consideration, in that case, whatever income generated by the transferee will be clubbed in the hands of transferor. But there are some special cases in which clubbing will not happen. In which case, if the wife and husband have separated from each other, then clubbing will not happen. But let's say, for example, one more case in which clubbing will not happen. If a residential house property is gifted by husband to wife or any spouse to spouse for inadequate consideration or without consideration, then the rental income will be taxed in the hands of transferor, not as per the clubbing provisions, but as the deemed owner concept under income from house property, guys. But yes, so you keep in mind one thing, rental income taxed in the hands of transferor only as a deemed owner under income from house property. Income earned from reinvesting the original income cannot be claimed. Let's say, for example, I gave money to my wife. My wife generated interest income out of that. Interest income will be clubbed in my hands. But that interest income she invested again in shares and she got some dividend. That dividend cannot be taxed, cannot be clubbed in my hands because income earned from reinvesting the original income cannot be clubbed. Now, if any asset, means any money or any asset is invested in some business, let's say, for example, I gave money to my wife invested that money as a capital in some business and earned some profit. Guys, mind you always, that profit will be proportionately taxed in the hands of transferor. How will I know, sir, how much profit has to be taxed? You take the income, means the profit of business, multiply with the gift amount which you gave and totally divide by the opening capital of the business as on the first day of previous year. Always keep in mind one thing. This business income clubbing will happen in the transferor's hand only if the capital, means the gifted amount, shall form part of the capital contribution as on the first day of the previous year. Only then the clubbing will happen. Remuneration received by spouse from a concern. Let's say, for example, if there is a partnership firm in which I have a substantial interest, means more than 20% of profit sharing ratio I have in a partnership firm. That partnership firm, if it pays excess remuneration to my wife, my spouse, then that excess remuneration will be taxable in the hands of me because that is not a fair remuneration. So remuneration received by spouse from a concern in which assessee has substantial interest. Substantial interest means 20% or more. No clubbing if professional skills exist. Means, let's say, for example, my wife itself is qualified CA. She deserves that salary. In that case, clubbing will not happen in my hands. But if she is not qualified for the job and unnecessarily excess salary payment is made, that will be clubbed in my hands in which I have a substantial interest. Clubbing of daughter-in-law, exactly whatever happens in spouse, exactly same way in case of daughter-in-law also the clubbing of income will happen. So any income from asset transferred by father-in-law or mother-in-law shall be clubbed in the hands of transferor. So if any father-in-law or father-in-law or mother-in-law transfer any asset, and if any income is generated, that income will be clubbed in the transferor's hand. Yes. And if any in business it is invested, that profit also proportionately it will be clubbed in the hands of transferor. Now coming to clubbing of minor income, very very important for your examination. All income of minor shall be clubbed in the hands of parents. Guys, generally, whenever a minor earns any kind of income, it is always taxable in the hands of parents only. But parents means wife, father and mother, no. In whose income it should be taxed? It should be clubbed in the hands of that parent who has the highest income apart from that clubbed income. In that parent's hand, it will be clubbed. But let's say, for example, if the minor earns income by way of any manual work or skill, then it should not be clubbed. Sir, what if the parents are separated? In that case, whoever the parent, mother or father, who maintains the child, that parent, in that parent's hand, it will be clubbed. And there will be no clubbing if the child is specially abled and he is receiving any kind of income. Clubbing will happen even if minor daughter is married. Still, she is minor only. Even if she is married, clubbing will happen. Mind you, only under optional tax regime, whenever income will be clubbed in the parent's hand, under optional tax regime, if the parent is paying taxes, 1500 rupees of flat exemption will be given, or up to 1500 you can say exemption per child will be given to the parent. Rental income from house property, I already told you, if a minor married daughter has received any immovable property for inadequate consideration, in that case, clubbing will happen. But in all other cases, income from house property will be taxable as deemed owner. But in case of minor married daughter alone, that rental income will be clubbed in the hands of the transferor. Rental income from house property shall be taxed in the hands of transferor present as deemed owner. But in case of minor married daughter alone, transferor of house property will be deemed as owner and clubbing will happen under section, will not be deemed as owner and will be taxed as per the clubbing provisions only. Next comes the set off and carry forward of losses. Guys, what happens in set off and carry forward of losses? You need to understand there are two kinds of adjustment: intra-head adjustment, inter-head adjustment. Intra-head adjustment means within the same head. Let's say, for example, one house property has a loss, another house property has an income. You can set that off, loss with the income. That is called intra-head adjustment within the head. But inter-head adjustment means, let's say, for example, house property has a loss, business has an income. You can set off that. That is called inter-head adjustment. So set off of loss within same head is called intra-head adjustment. Set off of loss with other head is called inter-head adjustment. Mind you guys, you can do inter-head adjustment, means one head with the other head adjustment you can do only in the year of loss incurred. Once you carry forward the loss to the next year, you cannot do inter-head adjustment. You can only do intra-head adjustment. Okay. Now, salary loss is not possible. House property loss is possible. But keep in mind few things. Only under optional tax regime, you can do inter-head adjustment. I repeat, only under optional tax regime, you can set off house property loss with other head income, but that too maximum 2 lakhs only. But if you are paying tax under default tax regime, you cannot do inter-head adjustment of house property loss, and that loss also you cannot carry forward. So, in case of house property loss, first do intra-head adjustment. Step 1. First see within the same head if you have, you do it. Then still losses are there, you go to the next head, other heads, that is called inter-head adjustment under OTR, optional tax regime only, maximum 2 lakhs. Still loss is remaining, you can carry forward for next 8 assessment years. But mind you, this happens only under optional tax regime only. PGBP, normal business income. Guys, in PGBP, there are 3 kinds of businesses broadly: normal business, speculation business, specified business. When I say normal business, it means other than speculation business and specified business. See, normal business income or specified business income or speculation business income, you can never set off business loss with a salary head income. All other incomes you can set off with, but never set off a business loss with a salary income. So if you have a normal business loss, first you will do intra-head adjustment within the same PGBP head. Then you will do inter-head adjustment, but except salary. Any losses pending, carry forward to the next years. Speculation business loss, very, very important. Speculation business loss and specified business loss, you can only set off with the same income. Means speculation business loss, you can only set off with speculation business income. Specified business loss, you can only set off with specified business income, mind you guys. Speculation business income, set off against speculation business income only. Interhead adjustment not allowed. Remaining loss carry forward for 4 years only allowed here. Specified business with the same specified business income. Set off of other head not possible. You can carry forward for unlimited years. Very, very important. Then short-term capital loss. See, remember in capital gain, short-term capital loss can set off with short-term capital gain or long-term capital gain. But long-term capital loss, you can only set off with long-term capital gain. You cannot set off with short-term capital gain. Yes. So short-term capital loss set off against short-term capital gain or long-term capital gain. Remaining loss carry forward to the next years. Mind you, capital losses you cannot set off with any other incomes. Interhead adjustment is not possible. Only intrahead adjustment is possible. Long-term capital loss set off against only long-term capital gain. You cannot set off with short-term capital gain, and interhead adjustment also not possible. Remaining loss carry forward to the next 8 years. Income from other sources. Loss from owning and maintaining racehorse, you can only set off with loss from owning and maintaining race horses. You cannot do interhead adjustment. You cannot set off with any other income. You can carry forward for next 4 years. But mind you, winning from lottery means if you have any loss from lottery, card game, puzzle, you cannot set off even with the same income, also not possible. You have to just forget about that loss. Any other income from any other loss from income from other sources, intra-head adjustment you can do, inter-adjustment you can do, but you cannot carry forward the losses. Keep in mind these points. Now, the next topic is special economic zone, 10AA. Maybe it may be asked as a part of total income computation. Now, what is SEZ? If you establish a business in a special economic zone, in that case, initial 5 years, first 5 years, 100% of export profit will be exempted under 10AA. And for the next 5 years, means 6th to 10th year, 50% of export profits are exempted. You can claim it as deduction under 10AA. And for the next 5 years, 11th to 15th year, you can claim the deduction of lower of 50% of export profits or amount you reinvested in SEZ reinvestment reserve, whichever is lower, you can claim. Now, the question is, what is export profit, sir? Very simple. Total profit you take. Total profit you take, the PGBP of SEZ unit, multiply with export turnover, divide by the total turnover, you will get the export profit. That export profit 100% or 50% you will take. Now in export turnover, one point is very, very important. Only that turnover you will claim, export turnover, which has been realized in foreign exchange, convertible foreign exchange. You repatriated the amount within 6 months from the end of the previous year or within the time allowed by RBI. That alone you can claim it as export turnover, guys. And there are some conditions attached, like you should be starting manufacturing or production or provision of any service in SEZ, and you should have got the approval by 31st of March 2020, but operations should have been started by 31st of March 2021, and the plant and machinery used in the SEZ should be new. Up to 20% of plant and machinery can be old, and the imported old plant and machinery will be treated as new plant and machinery only. Yes, and return of income, if it is not filed within the due date, then there will be no deduction of 10AA, and there will be mandatory audit of books of accounts under section 44AB. Then comes the next topic, which is alternate minimum tax. Guys, Alternate minimum tax is applicable only if you are not a company. So it is applicable to all assessees except the company, guys. And it is applicable if you are claiming 10AA deduction or 35AD specified business or 80JJAA, 80QQB, 80 RRB. If you are claiming any of these deductions, only then alternate minimum tax will be applicable. Now, what happens in alternate minimum tax? Very simple. You need to find out something called as adjusted total income. Adjusted total income you will calculate. On that you will calculate 18.5% of adjusted total income. That you will compare with your actual tax payable as per the normal provisions. Whichever is higher will come. That will become your tax liability. But AMT means this, whichever is higher. Now, how to find out adjusted total income? Very simple. Take your normal total income. To that, see, already you would have claimed 10AA or 35AD or these three, 80JJ, 80JJAA, QQB or RRB. You add back all these deductions which you already claimed as per the normal provisions. Then you reduce depreciation. Why are you reducing depreciation? Because on this 35AD, when you claimed 3580 deduction, you are not eligible for depreciation. But when you are adding back, when you are dissolving 3580, then you are eligible for depreciation. No. So depreciation 32 under section 32 on the 3580 assets you can claim, that will be called as adjusted total income. On that you will calculate 18.5% and you will compare with the normal provisions of the income tax, whatever tax payable is coming, whichever is higher you have to pay tax. Now, whenever you pay tax more than the AMT, in that case, you are paying the excess tax. But if you pay AMT is more than the normal tax, you are paying extra. There you will get AMT credit. That AMT credit you can utilize in the future years whenever you pay tax as per the normal provisions more than the AMT. Now keep in mind one point. AMT is applicable only if the adjusted total income is more than 20 lakh rupees. If the adjusted total income is up to 20 lakh rupees, AMT concept is not applicable. Okay. Now, so guys, this is the end of super fast revision of all the concepts. Only deductions, return of income, and the basic concepts are not covered. Why I have not covered in this is because return of income, some 20 minutes, one video I have uploaded. Return of income also I have uploaded. Return of income and the deductions. Chapter 6A. These topics, guys, if you don't know how to compute total income, I have uploaded one video in my YouTube channel. 15 marks in 1 hour total income computation, how to solve. That video you can watch on my YouTube channel. I have uploaded one separate super 50 adjustments of total income, one separate video. Super 50 adjustments, I have uploaded one video separately. Super 7 questions from which I feel adjustments may come in your examination. Super 7 questions, one video I have uploaded. Return of income separately, one video is there, some 20 minutes. Full return of income is covered in that also you can watch. And chapter 6 deductions also separately covered in one video, that also you can watch. So I have covered maximum topics, guys, and these topics already uploaded on my YouTube channel. Please do check out that content and hit a like button if you really liked the way I taught you these concepts, guys. My classes are available on both www.taxthalaiva.com or www.caclassroom.com. If you want to only buy income tax, you can buy it from anywhere. Or if you want to create a combo, you want full group 1, in that income tax, if you want my subject, my course, in that case, you can buy it from www.caclassroom.com, owned by Karthik Manikonda sir. Okay, guys, that's all from my end. Please write in the comment section, how was this marathon session? Did you like it or not? Last day before examination, I hope you liked it. And write positively in the comment section. Manifestation is true. So you write in the comment section, I am going to clear my examination in this attempt only, and pakka you will clear your examination in this attempt only. I'm damn sure, guys. Okay, the paper is going to be easy. Don't worry. It is not going to be tough at all. Yes. So prepare very well. These topics you will find already on my YouTube channel, Tax Thalaiva. And this PDF will be provided in Tax Thalaiva Telegram channel. So do must visit Telegram channel. You will find exam day revision exam day revision, one PDF will be provided that you can download. All the very best for your examination. Tata, bye bye. Take care.